Good morning, everybody. We had excellent day yesterday. All the panelists, all the speakers, beginning with Rajneesh ji and ending with the panel discussion. And Charanjit sir also had a very good talk. I'm sure today also we'll have a great day. We have a rocking day. I'll request Secretary WIRC Arpit Kabra to give his opening remarks.
Thank you. Good morning, everyone. Ketan bhai, first of all, congratulations for a well-lit conclave, a very apt conclave in these times. And just yesterday when we heard about wonderful news about ABG Shipyard, I think we all are, as chartered accountants, now really in the limelight in terms of understanding all of this and ensure that we stand up to this occasion and see what can we really value add. Shri Rajan ji Pental, today's first session speaker. Sir, good morning and welcome to this wonderful conclave. At WIRC, we always keep on evolving in terms of what are the new things that are hitting us or about to be hitting us, and so that we can be future ready in that sense. So today, fintech is something that is on the tip of the tongue of each and every individual who is even thinking to do something in this entire zone of digital technology and including the flavor of digital technology in every spaces of banking or finance or whatever. But one of the most important things that is exciting or that is something that is really forward looking is the entire concept of ESG, the entire concept of green finance. I think as a chartered accountant, we wouldn't have had a best time in our lives than this, so that if these are the real spaces where no one else than us can value add and can really contribute. Green finance, friends, is gonna come a big way. Every little place in this small planet is now looking up how to conserve our planet, how to conserve people, and how to conserve nature. For example, European companies, any investor from European countries, everywhere there is this ESG audit compulsory now. I don't know if you've already started working on it, but yes, it is time now. And every other space now is looking for green finance. Finance wherein there is green technology involved, wherein there is greener more, and there's more and more impetus, more and more encouragement to that. So I think when we talk about fintechs and all this, but there is something called as a new revolution which is coming in terms of financing. We should all gear up for that. And I'm sure today's conference, so yeah, after yesterday's conference, today's conference is gonna really add value to each one of us. Please stay connected, network with everyone so that you understand what are the different aspects where you can really plug in and really put in your best efforts. Also at this outset, we've just got ICI has got their new office bearers, and let us congratulate from WIRC the president CA Dr. Devashish Mitra sir and the new vice president CA Aniket Talati, who's also from Western region. Huge congratulations to all of them. From Murtuza, Piyush and Pinky madam, we are all very excited with these new office bearers, and we hopefully will the benchmark that the WIRC has set, we're gonna even cross that. So congratulations to all of you, and over to you, Ketan bhai. Thank you.
Ketan bhai, we can't hear you.
Yeah. Hello. Can you hear me
Yeah,
now?
Ketan bhai. Yes.
Yeah. Thank you, Arpit, for your wonderful opening remark. I'll request CA Pinky to introduce our worthy speaker, Sri Rajan Pental ji. Over to you, Pinky ji.
Yeah. Good morning, all of you, and thank you, Ketan bhai, for giving me opportunity to introduce today's learned speaker, Sri Rajan Pantil sir. So, Sri Rajan Pantil is the Senior Group President and Global Head Retail Banking at Yes Bank. He is responsible for galvanizing the retail banking franchise for Yes Bank. He carries a rich experience of 3 decades in the financial service industry. His portfolio includes SME banking, rural and agriculture banking, retail banking, affiliate banking and retail wealth, third-party distribution and MCC, retail collection, retail legal, retail service excellence, and customer experience and liability product management. So basically, I think his portfolio is for retail only, mainly for retail. He is also designated as a non-executive director of Yes Securities. Rajan ji brings with him rich experience in retail banking and building new businesses. He has held position of increasing responsibility in HDFC Bank 14 years. In his last role, he was designated as business head, secured loan and rural sales, vehicle loan, retail and wholesale. Earlier at HDFC Bank, Rajan ji was instrumental in initiating setup and institutes for the retail asset business for the HDFC Bank in the northern region. He has worked extensively in creating and executing the sales and distribution strategy of these businesses since inspection at HDFC Bank. Rajanji has been associated with Tata Finance, ANZ Greenledge Bank, Escort Limited, and Industrial Chemical Limited. He is a BSc from Patna University, 1986, and has done his MBA from IIM Patna University, 1988. He has also been completed an executive program for development of strategy skill from IIM Calcutta in 2004-2005. Sir, just to inform you, I am also from Calcutta, and my in-laws house at Patna only. So from both sides we are related. So most welcome, sir. Heartily welcome in our banking conclave. Sir, we are pleasure to hear you, sir.
Thank you.
That's for you.
Thank you, Pinky madam. I think, looking at the sir's vast experience, it would have been, he is the best person to talk about the opportunities and threat on fintech, as he is the guy in the field and, on the retail front for so many years in, various banks, including foreign bank. So, Rajan sir, over to you. The floor is yours. I'll start the presentation.
Thank you very much, ma'am. Thank you very much for a wonderful introduction. Thanks, Ketan bhai, and everybody else on the panel. It's really a privilege to be here talking to all of you. This has been, as ma'am explained, a wonderful journey of almost 3 decades. And I still remember from the time when we used to go in the field to get the applications filled from the customers. To a time when we are talking about a faceless bank and a customer who is having his presence in a digital form. It's very important to understand, and this is not just a discussion for today, but for the last 3 decades. While the retail business started and then followed by the SME business started, the banks in India in particular have been thinking about evolving ways and means to give a superior service to the bank. But with the advent of the fintechs for the last 10 years, I think the landscape has completely changed. The way the transaction is being looked at, the way the processing of the transaction is being looked at, and the way the technology is being looked at, and ultimately the way the customer is being looked at, I think everything has undergone a disruption. Now, I still remember around 10 to 12 years back in my previous organization when there was a threat of Apple coming in and Google coming in and everything else. Right now, the fintechs at that point of time, the fintechs were in a very infancy stage. So there was a team which had gone with the then MD to Silicon Valley, and they tried to study what is there, what exactly is happening in the Silicon Valley. The interesting thing at that point of time was the general perception was that the disruption which is coming in technology is actually going to be a very serious threat to the banks, right? So that was the perception, and the banks across the world, across the globe, started to prepare themselves to compete with the fintechs. So that was the first phase, and I'm talking about a decade and a half, that 5 years period. But over a period of time, the banks realized in their journey that what they are trying to do, in fact, is not their forte, because the fintechs would always work on the hinges, whereas a bank is a universal body which is kind of taking care of the entire ecosystem around the customer, and hence their responsibility is much larger. So what we will try to do today, instead of going all over, my thought process was that let us try to understand what is the fintech, what are they doing, under what situation and circumstances they are growing, and how the banks should look at them. So from the journey of looking at fintechs as a competitor to looking at the fintechs as partner has been, I think, one of the most interesting journey of this decade. And who all have benefited? I think not just the banks or the fintechs in running their own business models, but the ultimate benefit has come to the customers. So these are the aspects which we will try to touch upon today. Kindly feel free to ask anything in between you want to question, or you can keep your questions towards the end. And I will now start with the presentation. The topic being threat or opportunity, and that is exactly what I tried to explain initially about it. So let's look at what is the Indian landscape. Uh, and I would like to take a little pause here and talk about something which is very relevant and sitting within the banks, we are realizing it soon. The earlier, imbibing of technology concepts, research work, even customer perception or research on that was largely borrowed from the European world or the American world. But over the years, the good migration which has happened is that India in itself is very complex, and it is very important to understand how the right from thought germination to execution, how's India moving? And hence it is important that while we keep a very close eye on the developments in the international world, but we also keep a very close watch as to what is happening in India itself. So the Fintech universe, the total registered Fintechs in India are around 21,000 as of today. This is ever growing by the day, by the minute, across the geography in various parts. In fact, there are earlier what used to be top 10 cities. Now it has grown to at least top 100 cities. And it is also germinating very fast in the rural belt. So you can see that fintechs are trying to occupy a space in every nook and corner of the country, which is very good for the economy, which is very good for the customer. The industry growth in terms of the transactions carried out digitally are actually growing at a CAGR of around 20 to 22%. So a lot of the transactions are migrating onto the digital platform. The transactions, the digital transactions per month are in excess of 2 trillion in value, $2 trillion in value. And the interesting part, and here was my point, the largest growth in the recent past in the number of fintechs which are coming into the unicorns also, there is the contribution of India is gradually increasing. So 18 out of 187 unicorns in the fintech space are actually from India. Just to look at why what are the enablers which are resulting in exponential growth of fintechs. It's very strong computing power. Indian brains are for sure one of the finest and the sharpest brains across. There is a widespread internet penetration, and we were just before the meeting started, we were talking about how various networks are today available, and you have a choice to toggle between various networks. There is a better internet speed. There is a good coverage which we spoke about, and then there is also a inclusive financial services available. So that contributes to the overall Indian landscape. We can go to the next slide, please. Now, this talks about what is the regulatory outlook, how it has emerged. So Reserve Bank, along with the Government of India, have taken massive steps towards digitization. We have already seen in this budget a talk of digital currency. Crypto is the new word, so everybody is trying to get themselves updated. And whenever such a upgrade in the society happens, technology happens, platform happens, one of the most important thing is the regulator and the governance around that also evolves along with it. So digitization has been in majority of financial activities in the country, ranging from opening of the bank account or a loan disbursement or introduction of payment ecosystem, introduction and the penetration of Aadhaar and Bhim UPI are some of the examples, and I did add the digital currency, etc. to that. So how it has evolved, starting from the white paper rollout for policy formulation, then debate on use of blockchain technology initiated, innovation incubation through regulatory sandbox, which is a very big happening, and I would say one of the boldest step taken by the regulator in terms of allowing the sandbox to come. Then tokenization in cards ecosystem, and the last, which is too recent, is central bank digital currency will gradually come into the play. So I think uh, uh, while the whole ecosystem is evolving, the regulator is not left behind, and they are also trying to catch up with the speed. And where there used to be a gap of a couple of years, you can see today they are also moving shoulder to shoulder. We can go to the next slide, please. Let us look at what are fintechs trying to do. Now, before we get into that, I would like to talk something out of my experience. So what fintechs generally do, what is their way of operation? Because ultimately they are also trying to innovate, and that is the core strength of fintechs have. Fintechs would always pick up one thread of the entire transaction journey of the customer, try to create a unique facility out there, whether it could be in the functionality, speed, reach, penetration. So it could be any contours, right? But they would generally pick up one thread and create a competence. And hence you would see that in various pockets, there would be a cluster of fintechs who are trying to innovate that. So what it is doing is, one, it is creating a business model for them. To the customer, it is providing efficient multiple options, wherein the customer also is trying to understand the latent potential which he as a consumer or as a customer has. So let's look at what are the various shades around which the fintechs are operative. Digital lending is one of the most common. And in digital lending, the interesting part is that from a preview of doing a faster assessment of the submitted documents to using the information from the ecosystem and then analyzing it, to a stage wherein we are saying that can we do credit on a fly, which means that when the customer needs it, instantly the solution is provided to him. Two, which is much more interesting, is that can you do credit on a fly while the demand is still in a latent stage? So these are the 4 steps in which the whole ecosystem is migrating, and it's actually moving at a rocket speed, if you ask me. Then there are investment capital markets. So these are securities and investing businesses. Then e-commerce and marketing, again, one of the very, very large cluster where there are a lot of fintechs who are trying to expand that market. So B2B, D2C marketplace with embedded financial capabilities. Then fin media and data solutions and data analytics and maintenance, financial reporting, etc., whatnot. So this is whole lot of information what they're trying to analyze, dissect, put it in order, and then deliver. Insurance and healthcare is soon getting exploited. Payments, the largest contribution coming from fintechs, I would say. Security, HR, payroll tech. We are talking about a system HR, a system, a CFO, and whatnot. So there are very interesting opportunities coming. There are very interesting solutions which are getting created. And of course, the BPO, the digital processing of activities leading to a very large scale, with obviously comes with economies of scale. Fintech advantage, and I did touch upon this issue. So out of regulatory preview, unlike the banks and now, of course, the NBFCs, fintechs are generally, they do not have that restriction, that very large restriction, and hence there is more agility, which is helping them to grow exponentially. But mind you, the regulator is moving pretty fast, which would also regulate and create a long-term sustainability in the concept. Then disruption, fintechs are disrupting traditional banking. Enablers are fintechs are in a common market as seen as enablers to increase banks' ability to reach out to customers, and collaborative. The strength of fintechs and the experience of banks coming together can create a lethal combination. We can go to the next. Let us look at some of the disruptions which have happened through digitization. So embedded, and I would put some of the examples here. So embedded banking into customer journey, Threads is a typical example. Rapid product and banking channel innovations, Insta OD. Hyper personalizations of banking, use of artificial intelligence and machine learning, Bharat Pay, Paytm, Phone Pay, and we can keep counting. Emergence of platforms. Now, this is data layered based infrastructure during COVID-19, which has really given it not just a thumbs up, but the ways to survival for many parts of the industry. API, the integration of the banks with the fintechs, and the video KYC, which is remote access, faster KYC, no additional cost, etc., etc. We can just keep on counting, which have led to a very superior customer service. Let us look at some of the 5 blocks where some of the players in fintech are really being able to disrupt. So quick unsecured working capital, which is capital float, lending card, NDFI. So there would be at least, I would say, 500 people who are operating in this space. Then is receivable invoice discounting, so cred and drip, etc. Marketplace aggregation for lending, so it could be Paisa Bazaar, Bank Bazaar, cred, person. So then the alternate lending, we have again many players, and then SaaS and shared LOS, where Kuleza and many other partners, Jokata, who are also trying to integrate and contribute. We can go to the next slide, please. Now, how the banks are trying to react to it. Now, this is as I started, some 10, 15 years back, what was happening. From that to a realization that how can we use this mass of fintechs? So please try to understand. I will just give you a small example. We as a bank are trying to invade. Sorry, I'm using a little different terminology. From a bank's perspective, looks aggressive. But when I say invade, I mean invasion of reaching out to the customer. So when we are trying to look at, if I want to, let us say, as a cluster banking, look at Nasik. Now, if I want to enter Nasik, can I only go through physical means or can I also go through digital means? So this is the new thought process which are coming. So banks are trying to integrate with various set of customers. So banks can actually look at the fintechs from where a bank plays an important role, where bank can actually play a inclusive or a central role. So it can be the inventive bank as a supplier. So wherein I provide APIs and I become the back of it. So UPI can be a typical example where the disruption happened at the front end, but the entire payment system at a back end is being provided by the bank. Then it can be invited bank, which acts as the orchestra. So largely the functionality gets so seamless that a part of it is being played by the fintech and the part of that is being played by the bank. So they work in a very, very seamless manner. So let us look at an example wherein a lending fintech acquires the customer, but the entire processing actually happens at the back end, and it becomes a seamless service for the customer. And so this is what the term used here means. Then a universal bank as an integrator. So what happens here is that bank becomes a universal bank, and on each thread of its functionality of reaching out to the customers, either bank to customer or customer to bank. So when I say bank to customer means wherein the bank customers bank is trying to reach, and customer to bank is where all the customers which have been acquired by the outside ecosystem can also reach out to the bank and get the desired service and go back. So this is a very interesting space emerging. And then the inventing back as an aggregator. So which means I sit silently as a bank, and I let all the surround system to acquire customers for me and bring them, and I will service those customers. So banks can actually play a very interesting role here, depending on what kind of role the bank decides to play. And this becomes a very interesting part. And this is what the regulator is also trying to understand as to how should they dissect it and try to see. Or else, can the bank actually play as a universal bank, wherein the bank becomes a supplier, bank becomes the orchestration of the entire process, and bank also acts as an aggregator, right? So a large bank would like to have the entire three ecosystems around, but a bank can individually decide as to where they want to play an important role. So I would say that most of the banks would be market leader, at least in the top 5 into either one of them. And there would be very few banks who would be actually acting as an integrator for the entire ecosystem. So this is what is the real movement which is happening in the marketplace. Can we go to the next slide, please? So what next for the fintech? So there are also some associated risks involved, and that is important. It is important to have a very calculative step for any kind of a relationship, what I tried to explain in the previous slide. So let us look at, what are the risks involved, and out of these risks also, what is for the fintechs and also what is against the fintech. This is a very important slide, and also helps in deciding, what should be the contours which should be fixed up to think of to what extent do you want to go with the integration, to what extent do you go with the alignment of the platform, and at the same time, the dependence evaluation also needs to be done basis this. Because the sustainability of a fintech is of extreme importance, not just for the banks, but for the customer and for the entire ecosystem. So one is the outsourcing risk. So more external players involved, which are central to a bank's organization structure and hence higher need for due diligence, contract management, and operational risk and management. Come to the second part, which is operational risk. New product and services are increasing, and complexity of financial service delivery, making it more difficult to manage and control operational risk. The journey, while it looks very simple, so I look at some data and I disperse, but the steps involved in it are actually, because if you break it into microservices, this whole transaction, which looks so simple, which was actually very transparent on a piece of paper earlier, is today broken into various micro levels to cover up the challenges or the aggression you are taking in the whole decision making process, right? How efficient are those microservices, and how efficiently you are able to manage the risk of such operational risk is of paramount importance. And then the last but not the least is the compliance risk. The risk of non-compliance with data privacy rules may increase with the development of big data. So how much can I rely on the functionalities, the access which is available today, and if I develop and invest the entire technology around that? And this is not just a bank. As a chartered accountant, if you are accessing some information from the ecosystem, and you invest huge money on your technology and in your integration cost, tomorrow that concept might be called invalid, and hence your entire investments can be at a risk. And so this is from a user perspective. Look at from a fintech perspective. Tomorrow the government shuts down the entire concept. What happens to the entire effort, money, resources, and energy being invested behind it? So these are some of the larger challenges. But what is for further research in artificial intelligence and machine learning will lead to higher efficiency, safety, and compliance. And what is against, a few threats which may arise, which could be, sometimes being misused as money laundering. Let me give you one typical example. when the industry started video KYC for opening up the accounts, initially a lot of accounts which came were actually fraud, right? So so there could be, and it was if those accounts had been continued to be used by the customer, it could have led to money laundering. Of course, when you have large pools of data, large users connected to it, there is an increased risk of hacking, and also the digital identity theft. And I was talking to some of you yesterday where we were speaking about an invisible bank, which looks very high level disruption. But imagine an invisible customer wherein sometimes it is not a human and it is some kind of a machine or a robot or a bot with whom we are interacting and trying to do the transaction. So this also creates a contour that walk into it, but walk into it with a very I would say it has to be very calculated aggression with which one has to get on it. It looks very big, very interesting, but at the same time the contours have to be fixed and calculated. Yeah, please next. And this is the last slide where I'm trying to conclude. Future of financial services will be a journey not from bank to customer, but from customer to bank. This is the philosophy which will run not just banking, but every possible business in the future. And a part of it actually resides in the AI, ML, whatever you research or you read about it. It is the customer who will decide. Look at very small example of media. So you have the OTT base, you have the television, and you also have the other digital platforms where whenever in terms of Netflix, when which came into existence, it gave the power to the customer to decide when does he want to watch it and what does he want to watch it. So it was not from media to customer, it was from customer to media. And this is exactly what holds good even from a financial services perspective. Banks have to be omnipresent in a very competitive environment. What I want to say is that since it is a customer who's deciding, so customer could be residing in any nook and corner. Customer could be sitting next to you, but he will decide when he wants to open his eye to you or when he wants to use his finger to press a button to access you. So in this competitive environment, the banks will have to be omnipresent, some directly and some through integrations, some through partnerships, and some through aggregator model. So competitive environments makes it imperative for the banks to be omnipresent. Banks should be present when the customer demand is even in the latent stage, when you're not thinking about what you need. When I try looking at it, that tomorrow you might need it, day after you might need it, and I prepare it accordingly. People have been in past talking about customer life cycle, but let me tell you, customer life cycle today is the most interesting subject, which needs a lot of research and which needs a lot of upgradation. Then the orthodox thoughts about this will lead to the next step and this will lead to the next step. That next step, customer himself does not know what does he need. So how will you predict it? And that makes it even more interesting. Banks will have to look at more evolved models and try to reach every possible contact point where customer interface is active. To meet these goals, banks will have to work on an open architecture and through APIs try to connect with all the possible sources, including fintechs. Now, this statement actually tells you that are the fintechs today a threat or an opportunity, right? I think there is a common understanding, and this is where the regulator also has started playing the important role, that fintechs they will never be able to become banks, right? But they will operate in their fringe area, and you have to reach out to them to integrate so that through their access you can reach out to your end customer. And last but not the least, banks will have to ensure to maintain data integrity of internal customers, data to provide solutions, not restricted just to their own customers, but to customers of competition banks as well, which means that customer data is not going to be anybody's conserve. It is not going to be anybody's conserve. Today, you have seen mobile portability. you will have the account portability, you have in a way loan account portability. So you cannot look at saying that he is my customer. So there is nothing called my customer. Customer is absolutely the God, right? And he has all the choices, and whatever built up you have is not just restricted to you. It is meant for the entire ecosystem. He can come from anywhere and he can go anywhere. So just be prepared for a highly mobile customer and see to it where you can do your interventions. So this is all what I had. This is one topic on which, I can keep talking, because this is the 90% of the work which today banks are engaged in, apart from, large investments in the technology. But clearly, I want to put it over here. The innovation has become the conserve of the fintechs, and how to get those ideas embedded into a platform is the responsibility of the banks. So banks have to look at all the fintechs more as an opportunity and respect them for what they are, at the same time keeping itself within the contours of the regulatory framework. I think that is the most interesting journey going forward for all of us. So thank you. I'm through with my presentation. Any questions?
Thank you, Rajanji. I think it was an all in all crisp, excellent presentation. And we always tell Yash Bank is a technology bank, and I think that is being clearly demonstrated. As Rajanji talked about the various technology. Of course, he gave a clear message that customer is a king, and where customer will press a button or where he'll put his thumb is to be seen, and we need to be customer friendly as a banker. And also, he very clearly says that fintech is an opportunity. Rajanji, in fact, I'll request CA Rudesh Pankhani, RCM elect, to propose a very well-deserved vote of thanks. And time permitting, you can stay back with us in the seminar, and we can have you in the panel also. Thank you so much. Over to you, Rudesh.
Sure. Sir, am I audible?
Yeah, Rudesh.
Yeah, sure. First of all, thank you so much, Ketan sir, for giving me this opportunity. And I think this was one of the wonderful and most needed topic at this point in time, not just in terms of banking, but across the way fintech startups are coming across. And very rightly picked up whether it can become a threat or an opportunity to the entire community as a whole. And I think Rajan Pental sir, you explained it so well. And so rightly said, Ketan sir, that Yes Bank definitely, when it comes to technology, we look up to Yes Bank. So absolutely, many thank you so much, Rajan Pental sir, for explaining all these concepts so well. And as rightly said, customer is always going to be, the main, where each one of us could be any startup, have to focus. So thank you so much for guiding us over this topic, and we look forward for more such sessions with you, sir. Thank you, Rajan sir.
Anytime, anywhere. I'm just a call away. Thank you. Thank you very much.
Thank you, sir. Thank you so much. Anup sir, you're there, Anup sir? Anup sir is joining in a while. In fact, this when we were planning this 2-day session, we had a lot of deliberation, and we thought that the technological development and fintechs are going to be as rightly Rudesh said, we had a debate that whether it will be an opportunity or it will be a threat to the banking industry. So what is happening that the new generation is more into technology, and they want everything on their fingertips, and they want everything in mobile. And the youngsters, if we ask them, they'll say, "Ke bank mein kyun jana hai? Why we have to go to the bank?" And when we can get all the information, transaction, bank statement, we can do payment, we can receive everything in mobile. So no one is going for the to physical visits at the branches. So that's where the all discussion started, and we thought that this is the best topic, and the technology will be the key driver tomorrow for all the industries, including bank. And in that sense, we kept today's two session on technology and fintech. The next session is by Anup sir. Mintifi is one of the leading fintech, and we thought of various options, and when we checked up with Anup sir, he was very positive, and he said that he'll love to do this session. In fact, he was very busy. Those who track, I'll just tell them, recently in the last week only, they got some 300 crore funding. Mintifi got some 300 crore funding. It was some Northwest Venture Partners and Elevation Capital who were the investor in Mintifi. Mintifi is mainly into buy now pay later technology, and approximately their loan book is around 2,000 crore rupees, and they are the leading fintech from Mumbai. In fact, Anup was very busy, and as I said, because of this transaction, and also he had some social function, so he's traveled to his native place, and he just he'll join in 1 minute. I'm just in touch with him. He's just logging in, and the moment he joins, we will immediately start.
And I think it's an excellent topic, sir, to be discussed, the startup funding life cycle. In fact, all of us talk a lot on startups, everything, but I think life cycle of a startup becomes very important these days. Here, Anup sir is.
Yeah. Anup sir, welcome. Welcome to the WSC Banking Conclave.
Thank you, Ketan bhai. Thank you, Ridesh bhai. Thank you for giving the opportunity. Really appreciate being on this forum today.
So I was stating that you must be very busy. This last week you had this funding of 300 crore, and also as you said, you are in some function in Rajasthan. So I was mentioning that we are troubling you in your personal time also, and you have been kind to join the seminar on Sunday morning. And as I said, buy now pay later, they almost Mintifi is having 2,000 crore book, so we can understand how busy Anup sir will be. But it is his love and affection towards our CA Institute that he readily, over one call, he said that yes, I love to do this. So thanks to Anup sir. Rudesh, I'll request you to formally introduce CA Anup Agarwal.
Okay. Welcome back for the next session, everyone. I think the topic very well taken, which is going to be startup funding life cycle, and I think who other better than CA Anup Agarwal sir we could get for this, who himself is a co-founder and CEO at Mintifi. Mintifi is India's leading B2B BNPL platform, which works closely with over 100 leading brands across India, including Tata Motors, Bridgestone Tires, Berger Paints, Jockey, etc., to unlock their supply chain by digitizing payments, invoicing, and purchase financing solutions for their distribution and retailers. B2B payments have traditionally followed rigid one-size-fits-all credit terms that are not tailored to the cash cycle needs of distributors and retailers. Mintifi's payment and financing stack creates a win-win proposition for brands, distributors, and retailers via improved payment processing time and increased inventory turns, thereby fueling revenue growth across all the supply chain. In fact, prior to Mintifi, Anup was a managing director, head of internet, fintech, media, and telecom investment banking at Jefferies Investment Bank, where he has advised and over $10 billion of transactions across M&A, private equity, and capital markets. I think this is going to be a very interesting session, to understand the life cycle, which is, I think, very important. And thank you, Anup sir, for being kind enough on this Sunday, as rightly said, Ketan sir said, been occupied with a lot of, in fact, work as well as personal commitments. We welcome you, and we're looking forward to this session. Over to you, Anup sir.
Thank you. Thank you so much. Really appreciate your kind words, Ketan bhai, Ridesh. Very kind words coming in from you. And this is my family. I've been a chartered accountant for nearly 20 plus years. So it's such a pleasure to be out here this morning. Personal commitments aside, I think it's great to interact with fellow chartered accountants, and whatever little that I've learned in life, it's thanks to my CA fraternity and thanks to my professional career. So very pleased to be here out, and thank you all for giving me the opportunity today to speak with everyone. So as you rightly mentioned, I think the topic is interesting. There is a lot of money chasing this country today, and clearly, I think there's a lot of excitement around this whole startup community. And just to put some statistics, which will kind of give you things in perspective. Last year alone, 2021, $36 billion worth of capital came into this country, and this is only towards private investments. We are not here talking about public market investments. We are not talking about the IPOs of the Nikas and the Paytms of the world and so on and so forth. This is private money coming into all the unlisted startups in this country. Around 1,400 startups got funded across various Series A, Series B, and so on and so forth. So the market is evolving. Just around 3 to 4 years back, when I was an investment banker, even to get to around $4 to $5 billion worth of private money coming into the Indian ecosystem way back in 2015-16 was seen as a very, very big number. And that number in just 5 years have grown close to 7 to 8x now. So market is certainly evolving very, very quickly, and there seems to be a fairly large interest. And particularly after we've seen a lot of issues coming in from the China front. Outside of US, if people are looking at a large market to invest, particularly in the technology side, I think India is the second largest market right now, and that is the reason why you're seeing so much of capital coming into the Indian ecosystem. I think the topic that we're talking about today is fairly interesting. A lot of people are excited to know, how does this whole thing happen, and how do we go about doing this fundraise, and what are the various processes and so on and so forth. To a large extent, and not because we've raised capital, I'm saying that. I genuinely believe that to a large extent, capital is a commodity. To the extent that you have a very, very strong business value proposition, you have got a tech enablement into it. Old businesses would somehow find it tough to raise capital today, but it can be any business. I mean, it may not necessarily be something which is a 100% technology company. I mean, at the end of the day, what Mintifi does is pure lending business. It's give and take money, right? But the whole way in which we go about executing it has a lot of tech into it, and that is the reason why investors have put money into Mintifi. And that goes across the board. Today, a lot of companies which, if you would look at it and say, hey, what is the technology element into it? But the way they have gone about building the processes, the systems, the way they have built in efficiency using technology is what is, investors liking it. So it did not necessarily be, something like an Ola, which is a car aggregation company, or necessarily like an e-commerce company or a deep tech and stuff like that. It can be a basic company, which is, all traditional methods and stuff like that, but has a lot of tech enablement to ensure, as compared to the way people were running the businesses earlier, today you're able to create a lot of efficiency using technology, and that's what investors are liking. And to the extent, I'm sure a lot of you guys have deep access with your clients and the startup ecosystem. There is a big opportunity to go out and raise capital. Specifically, if I talk about the various cycle and the various stages at which the capital can be raised today, it's a whole host of universe that exists in the market today. You've got what I call it as friends and family. That's where whenever you're starting up with, I think the first point of call that you reach out to is of course your friends and family. And there are a lot of people who have made a good amount of money investing either in startups or in the capital markets in the last couple of years, and I clearly see there is a massive risk taking appetite that is there today in the startups. So as compared to earlier, where people would shy away from raising money from friends and family, I think this is the right time when you should certainly reach out to them, because a lot of people are looking in for that exponential growth and exponential return. And to that extent, if you have the right idea, I think people will certainly back you for that. The second layer, so to say, as you keep progressing up the chain and as the rounds become more and more, what I call it the professional-led rounds. And what I mean by professional-led rounds are people who understand the startup ecosystem a little better. They're slightly more patient with their capital. Friends and family, of course, will support you, but at the turn of any bad event may start chasing you for returning their capital. But if you look at outside of that ecosystem, the first, so to say, layer that comes in is what people call as an angel network. An angel network is nothing else but a group of people who want to come together to put money into a venture instead of you having to go to 10, 20 different people. These are network of people. These are typically what we call the HNIs, high net worth individuals, who would come together in any of the forum, there are multiple such angel networks. There's an Indil Angel Network, there's IPP Ventures, there's Mumbai Angel Network. So there's at least 100+ such angel network that exist in this country, and they invest anywhere between, let's say, 50 lakh rupees going all the way up to 2 crore rupees at as early stage as an ideation. You don't have to have any even a proof of concept, but so far you have two very, very important traits. Number one, clearly you need to be master in the subject that you're coming in from. Typically, they would not fund somebody who's talking about, let's say, wanting to build an e-commerce business, but does not understand technology, right? I mean, so what investors would essentially try and looking for is there a right fitment for the job that people are pitching for? So I think clearly one is the education background that you're coming from, and second is how big that opportunity is. So if you can really convince these people that though you are starting up, though you've not done anything right now, but the market sizing is so large that even if you become, let's say, the top 5 players in the industry, they will be a fairly large outcome for them. These guys will be ready to invest, and that is where today, unlike in the past where you have to wait a lot of time frame before you can get to profitability, you can redeploy the capital. The beauty about the whole startup ecosystem today is that if you have a great idea, if you have a great team around you, you can certainly raise capital even on paper. On one hand, it's a great start. Of course, the money is not large. You can't think about, of course, there could be exceptions to the case, but you typically will not be able to raise more than 1 or 2 crore rupees at this particular stage, because it's not even like a proof of concept that has yet been out in the market. The third stage is where, depending again upon the stage and depending upon your relationship in the industry, is the network which is called the super angel network. Now, what is a super angel network? Is nothing else but a group of people who are super successful, having done a tech startup themselves. So somebody like a Deep Kalra, Sanjeev Bikhchandani of Naukri, Kunal Shah of Cred, all these people have a huge fan following across the investor base, and typically, as is perceived, not necessarily that could be always true, but typically as is perceived that if these guys invest into a company, they understand these businesses well, and therefore your next round of funding becomes slightly more easier. So to the extent you are able to convince any of these, what we call it, it's almost like these are celebrity status. And if you have a celebrity who's backing you at an early stage in your career, there is a fairly high chance for you to get the subsequent round of funding as well. Now, of course, that also means that you need to connect with them at the right level, and you need to ensure that they give you the audience. A lot of these people are super busy and have multiple people chasing them for their pool of capital. And most of these people are investing from their own pocket. They are not investing from a third-party fund. And to that extent, they're also a little selective in the way they go about investing. But that is clearly a capital that gives you two very important things. Number one, it gives you a lot of limelight. You suddenly are known in the market that X, Y, Z has actually invested into your company. And the second important thing that they give it to you is basically access to a lot of high quality blue chip investors globally. Both of which are very important, particularly for people who do not come from this industry, as to how to reach out to the right audience and how to pitch to them and so on and so forth. The Super Angel Network helps you to ensure that you at least have the right audience. A lot of time people are not able to raise capital because either they do not have the access to the right set of people, or maybe they don't know how to pitch the idea in the right manner to, at the right forum. So that's the third, so to say, the layer that comes in. Once these three layers are over, is when you can look at raising what is called as an institutional round. An institutional round is nothing else but where people have kind of putting money from a fund. It is not your money, your personal money or my personal money. It's about somebody who has raised a fund, and from the fund manager is making an investment into a company. The seed round typically can start from as low as $500,000, and today, given where the markets are, it can all the way go up to $2 to $3 million as well. Typically, before any of these rounds happen, and a lot of my fellow colleagues out here on the call would also be advising their clients as to how much of dilution that they should be taking at each particular round. And while there is no kind of a science behind it, but typically the rule of thumb is that before you do a series A round, or before you do in fact seed round as well, most of the transactions actually do not happen at a particular valuation. You do it what is called as a CCPS, compulsory convertible preference shares, and it is done at a discount to whatever the round happens or the valuation happens at an institutional round. The institutional round could be a seed round, or it could be, for that matter, go all the way up to a series A round as well. So the idea is that, I don't know what the valuation of my company will be when I am negotiating with any super angel, or I'm negotiating with a HNI or a family office. I'm today gonna take the money from you, and whatever is my next round gonna be, I'm gonna give you. It could be as low as 25 to 30%, and can go all the way up to 40 to 50% as well. So I'm gonna not peg the valuation today upfront, but I'm gonna give you a structure which is at a discount to the institutional round that happens in future. Once this institutional round starts happening, that's where the real, so to say, serious money starts chasing you, and that's where also the performance pressure starts coming in. A lot of times, there's a bit of a myth in the market that if you're able to raise whatever 20, 30, 40 crore rupees, then it's very easy to raise capital. It's actually the reverse of it is what is happening in the ecosystem today. As you keep growing up the ladder, the number of investors becomes far more lower. The ask from the investors in terms of what your business model is, what your unit economics is, how your growth plans are, all of those things becomes far more challenging. And that is the reason why, if you see this $36 billion that got invested last year in India, of the 1,400 companies that got this $36 billion, 100 companies alone got $32 billion. So, the market is fairly skewed towards only the top, whatever, 5-7% of the total universe. And these are the companies that, investors are ready to back again and again, because they're showing high growth, they're showing the large market presence, they're showing the leadership in the market, and so on and so forth. So the point I'm trying to make it is that at the seed round, the angel round, or maybe till about series A round, there is a lot of money available in the market today, and anywhere starting from as low as between 50 lakh rupees going all the way up to 20-30 crore rupees of capital up to the series A round. You will certainly have a lot of investors who will be happy to back the right team, will be happy to back the right idea, and so on and so forth. But also after that, it's all about the execution that you demonstrate to the investors. Whatever you had promised to them in your business plan, whatever the team that you had demonstrated to them, how are they working together, what is the problem that you're trying to solve for, all of those things becomes extremely crucial before you can look at raising your series B, series C, and so on and so forth. A lot of time people, again, from my limited experience, a lot of time people also keep debating about it, is that how important is growth and how important is profitability, and so on and so forth. I think everybody to its own. We as an organization has always been focused on ensuring that we do what we call as a profitable growth. We will certainly grow very, very quickly, but at the same time, we will not compromise on the unit economics or on the profitability. But that may not necessarily work for everyone, right? I mean, some people who are in the market leadership position and have the ability to convince the investors at a much better way than most of us can do it. They would be happy to keep raising capital at every now and then, or every small interval, but not compromise on growth. They will only focus on growth to ensure that they are able to attract a lot of investors who are looking or who are chasing growth stories in this country. So there are two ways to build it out. One is to build it out in a slightly more moderate growth, but continuing to focus on unit economics. There is a capital available for that, and there's enough and more capital available for that. And then there is a bunch of fairly high growth companies which are only focused right on growth and getting the market share or the leadership position. And thankfully there is enough and more capital available for that as well. But the universe of investors for both of them are very, very different. And a lot of times we do not pitch the right idea to the right forum as to who is looking for what. And this goes across the board. The moment you are at series B and above, that's where the selection of the investors, what is the understanding that they have about the business, what is the kind of companies that they have backed globally, all of those things starts playing a very, very important role for people to decide as to, what is the kind of investors that I should be choosing and whom we should be going out and pitching to. Because a lot of times, again, it's a standard value proposition where, I chased 10 people, but nobody liked my idea. Maybe they are not actually fit for it, right? I mean, they are not the right set of investors who invest into this particular, industry or the segment that you're playing in. And therefore, a lot of, so to say, importance needs to be given to whom are you reaching out to? Are they the decision makers? Are they the people who invest in a particular, ecosystem and stuff like that? The second thing that plays a very, very important role is that people start benchmarking themselves. And, this is a classic thing that we're also seeing in this fairly successful series, The Shark Tank, where a lot of people come in with a very unreasonable valuation expectation. No execution being done, or maybe small little execution being done, and few crores of revenues coming in, and suddenly the expectation would be that I need to raise a few hundred crores at a valuation of whatever 500 crores, 1,000 crores, and so on and so forth. We need to all appreciate, and this is something as a fraternity, it's our responsibility as well to guide these people to ensure that the expectations are reasonable. The people sitting on the other side, they are very, very smart bunch of people. They understand the businesses exceedingly well. On a daily basis, if not more, they are at least evaluating 50 plus ideas. So that's the level of understanding that they have. I wouldn't say that everybody would get everything. I would certainly not say that some people may not be lucky to get a fairly what we call as a premium valuation, but that's a fairly handful bunch of people who, because of their past experience, because of their successful track record, they will be able to raise that capital. But by and large, for most of the people, you have to get through the journey where people are gonna give you capital once you demonstrate to them whatever you had promised. And then there's no dearth of capital. But till the time you don't do it, if you day one, or maybe after every subsequent round, you want to continuously just keep inflating your valuations, people will shy away, because they are also carrying a lot of risk when they're investing in a company. And to that extent, they would be pretty mindful of wanting to ensure that their money, which is their investors' money, do not end up not making returns, right? Just like how we all are trying to make return for ourselves, they're also in the business of making returns for their investors. So very, very important to ensure that we kind of reaching to the right set of people, and at the same time are fairly so to say balanced in our approach to ensure that our expectations is not unreasonable. From Series A, Series B, Series D, as the scale of the organization keeps increasing, the size of the funding, so to say, will keep increasing as well. And the beauty about it is that as you keep scaling from what you initially had, let's say every round you would take a 25% kind of a dilution. The dilution that you would start taking as you go to, let's say, a Series D or a Series E and Series F will also start reducing pretty significantly. In fact, if you are at anywhere between a Series D and Series E, and you've already raised anywhere between $200-300 million, you are at a unicorn stage, you can raise the next round of capital for as low as a 5% dilution as well. So you can easily go out and raise $100-200 million of capital and still not dilute your ownership in the company by more than 5 or 10%. So from 30% or whatever 25% at the start of your journey, going all the way up to 5% is what is possible. And that's the beauty about this entire funding, where on one side you're getting an opportunity to be an entrepreneur, which is for most of us it's a dream come true. Number two, you do not have to invest your own capital. People are ready to back you with their own capital and risk that. And number three, as you keep scaling up, as you keep demonstrating to them about the success of the story, you can keep getting more and more capital and still continue to be have a reasonably high ownership in the company as well. The last stage, of course, for any company is once you've gone through all the various public private rounds, and there's no dearth to private capital. So it's not a case that you necessarily have to go and get yourself listed. Today, companies have chosen to remain private for as long as good 10-15 years as well. Have raised all the way up to Series F, Series G, and so on and so forth rounds as well. But yes, the eventual stage for most of these private companies will be either a strategic stake sale or a public market listing, where you will be getting yourself listed on any of the, whether it's an Indian stock exchange or a national or a New York Stock Exchange. And the other alternatively is of course where you look at doing a strategic transaction with any of the other competition in the market, and that's where the investors get liquidity. That's where for the ownership that you own in the company, you get your liquidity as well. So it's a journey that people go through. It can be a journey which can be a good 3-4 years journey, and it can be a journey which can go all the way up to 10, 15, 20 years as well, depending upon, as an entrepreneur, how long would you want to continue to build the business? Where do you see the opportunity? And more importantly, I think where you see this business, you can personally take it to. And clearly, I think so far you are executing on whatever promises you've made. There's no dearth of capital for sure. So that's where we are. I think market is fairly vibrant, and as I said earlier, I think we should all ensure as part of this ecosystem to get more and more entrepreneurs in the ecosystem, and get more and more of these people to get backing of the right investors. So I'll just pause here. Happy to take any questions that you may have. Ketan, sorry, I can't hear you.
Yeah, sorry, I was on mute. I was saying that you have passed through the entire life cycle. As I said in the opening remark, almost you are managing 2,000 crore rupees. Can you give few tips? Because I have been seeing that new chartered accountant, everybody is having this fancy of doing startup. So there are two things which I want you to tell. One, what is not to be done out of your experience for the new chartered accountant who are thinking startup as a big area. What is not to be done? Second, maybe 2-3 tips. How do they begin? See, when it is first round of funding, or when I want to have the capital, a lot of time I'm desperate, I'm not getting funds, and I may go and dilute more. Third aspect is what is more important is numbers or customers or technology, where one should put more stress.
Sure. So, Ketan, again, not a perfect answer. I think it's a very wide subject, but to the extent I can justify the question. Number one, with due respect, Ketan and to everyone, as chartered accountants, we do not have a very high exposure on the technology side. And while we are very, very strong on operations, on finance, on taxation, legal aspects, and so on and so forth, and to a large extent, on this forum, I can very proudly
Yesterday,
say that
Anil by CA Anil Bhandari was saying same thing. In a future, ICI will say that first you do engineering and then you join CA.
No, in fact, as I was mentioning earlier, if you today ask me for my son, if he does listen to me, a lot of times, these kids are not going to listen to you. But if he does listen to me, my preference would be that you should first do your CA rather than any other course. I think chartered accountancy is the best course available in this country. But having said that, I think the key aspect to this whole thing is that investors are not looking at all these skill sets till the time it's not backed by technology. So you may have the best idea. You may want to build the next Facebook. But the starting point is how you're going to go about executing it. And that's where I think it's not, okay, so it's not that, okay, so then what do? I'm not a tech, so I can't go back and now do engineering, right? We need to find partners, we need to find collaborators who can help us do this together. And that is where the co-founder roles come in play. I think everyone needs to invest into building into that ecosystem where they can get the right tech partner along with them. I won't call it tips and stuff like that. I can just talk to you about from my own experience. We failed miserably when we went out and built the platform that Mintifi was trying to build through a third party, what they call the software services companies, right? You tell them, okay, this is what an idea I have. I've written everything on the paper. Why don't you help me build a product? Nobody's gonna do that for you. They're gonna take a lot of money from you. You will end up bleeding a lot of your hard-earned money, and unfortunately, the product that will come out will not meet your own expectations. So therefore, if at all people are serious about the tech startup or are serious about building a tech-led businesses, if you're not serious about building a tech-led business, it is fine, right? You don't need a tech co-founder. But if you are serious about building a tech-led business, you need to get a tech co-founder for you. And that's where I think all of us need to invest a lot of time and get the right partnership going. And once we have that, I don't think so, because we will be very good in finance, we will be very good in operations, raising capital, and so on and so forth. And the other guy can help you build the entire tech stack, which will give a lot of credibility to the investor, to your startup in front of the investor community as well. That though you are not from a tech background, you've been able to convince somebody who's coming from a tech background to work with you. And I think that is where the real skill sets of all of us come in play. And then there are a bunch of other small things. I think do not try and burn a lot of capital. Be super efficient with your capital. I think every penny counts, even if it is a third party money. Please ensure that you are a trustee of that capital. You need to return that capital back to them, and therefore please ensure that every penny is, whether it is from the day one or whatever stage you are, please ensure that you preserve that capital. And the last and the most important thing, I think, again, it sounds a bit of a cliche, but it's what is the problem that you're trying to solve for. If you really genuinely believe that this problem is real and you can solve it in the next whatever 1 year, 2 years max, you should give 2 to 3 years of your time to see whether that problem is actually being solved or not, and you'll be able to scale. Do not get married to your idea. Do not keep investing. A lot of times, unfortunately, people end up spending all their life savings just to prove that their idea has more value. Please do not do that, because we have a family to run. We all come from very humble backgrounds. So it's very important to cut your losses at the right time and move out, and start investing into doing something else.
So Anup, any other tip what is not to be done? Like as you rightly said, we should not go to, we find a tech partner. That's the right way instead of going to any software company. Any other tip out of your experience of startup? Because you had a vast experience. You were earlier into funding of the startup, and then you did your own venture. So kahan pe log where people do more mistakes out of this entire experience?
So I think it's all about the only two things. I think one is about getting the right team. I can't more overemphasize on how important is the right co-founder, or for that matter, how important is the core team who will be building this out. It's not a journey that will get done in 1 year or 2 years. And just because you raised a capital, that again does not mean that the journey is over. It's just about starting it. So a lot of emphasis needs to be given to people who are like-minded, who want to invest in the next 5 years of their career with you, which is I think the most important thing. And second is, I think, as I mentioned to you earlier, do not try to be me too. Do not try and say, if somebody else is doing and somebody else has raised capital at a crazy valuation, I should be doing the same thing. So far, you genuinely believe in the idea and you have the patience to build it out over the next 5 or 10 years. That's where you should, take the plunge and build it out. A lot of our conviction today, in the models, with due respect, is driven not by the problem that exists in the market, but is driven by the valuation that exists in the market. And that's where I think people make mistakes, because they suddenly get disheartened when they go out in the market and then they start executing it. They realize that it's a painful journey. It's not easy. It doesn't happen overnight. There will be, of that 100, 200 companies out there in the market, maybe one of those guys turned lucky, had great execution skill sets, had great management team, and got in funding ahead of its time, or maybe got funding at the right time, whatever the case may be. But not necessarily everybody would do that. And that doesn't mean that if you have not got money early, you will not be able to build your business, right? I mean, you need to have patience. At the right time, capital will come to you. But it's important that you stay invested so far you're really solving for the problem that you thought was a key problem that existed in the market.
So, Anup, is there any minimum capital if, as a new chartered accountant, I want to start the startup, I want to invest my money, and as you rightly said, I have a tech partner. Any sort of base capital which one should invest from, again, funding perspective?
Yeah, again, Ketan bhai, it's a function of what kind of a business that you're building it out, whether it's a SaaS service, whether it is e-commerce, whether it is lending businesses, and so on and so forth. So I think different industries would require different kind of a capital. But yeah, at the end of the day, you do require some capital before you start venturing out. I think, given the fact that you have to pay your bills, your rent, your multiple other employee salaries, and so on and so forth. To my mind, at least budgeting out 50 lakh rupees to a crore to begin with, so that first 6 months you can do some what we call the proof of concept before you go out in the market and raise institutional capital. So I don't think you need a lot of money, but you certainly need at least 50 lakh rupees to a crore to ensure that you are having some oxygen available for you to build a business.
The last question, Anup, from my side is that when I'm out in the market, we have been seeing most of the time the valuations are done on the DCF basis, and future cash flows are being projected. But what I feel that you need to have genuine customer base. Basically, whenever the person who is investing, he wants to see that who are your customer, what is cash is going to be generated, but from where it is going to be generated. So any feedback on that what is more important, or when I go for valuation in the market, or when I go for first funding in the market?
Yeah, so I think as I was mentioning earlier, I think the first round of funding always largely happens on the back of the founder's background, what academic background they're coming from, what is the kind of experience that they carry for themselves, and of course is the problem that they're trying to solve for, and how big that market sizing, or what we call as a TAM, total addressable market is. I think any subsequent round that happens is on the back of all the execution that you have done to prove the fact that let's say I took 1 crore rupees of external money, and with that 1 crore I've been able to grow whatever from 1 to 5. Now from 5 to 50 I need so much of capital. I think that is very, very important. What people are miss out on is that you can raise the second and the third round of money without demonstrating to people what you did with that particular capital. It's very important to be mindful of the fact that investors would, every time you take money, they would want to understand what was the use of that money, and whether you're able to grow your business to the next level before you can be justified to get the second and the third round of funding. The second point, Ketan bhai, you mentioned about this whole DCF, and well, all these are great tools to value the company. Eventually, as they call it, the beauty lies in the eyes of the beholder, right? I mean, there is no benchmarking here. If you are able to convince people that this is a large opportunity, and you have the numbers to back it, and the numbers are not just to say the number of customers, right? There are a whole host of things. These are very highly intellectual guys. They will rip you off, understand a lot of data points to get conviction that if you are asking for an X valuation, is it really justifiable? And therefore, whether it is growth, number of customers, unit economics, the market sizing, all of those things plays a very, very important role before people give you money. But there's no benchmark at all. The benchmark is only about your ability to convince and their ability to see how big this entire opportunity can be.
Great, thank you so much, Anup. All in all, we had excellent session, and looking forward for such more sessions from you in WRC and ICI based on your availability of time. And I'll request CA Rahul Javeri, our coordinator, to propose a very well-deserved vote of thanks. Rahul, over to you.
Thank you, Ketan.
Thank you, Ketan. Thanks a lot, Anupji. Thanks a lot for spending time with us. It was really insightful session. You've learned a good amount of things based on your experience, and I'm sure attendees also would have felt the same. It was a pleasure having you, and on behalf of the WRC Banking and Finance Committee, I would really like to thank you for all the efforts and time you have taken to explain us the topic.
Thank you for having us. Thank you once again, everyone. Thank you.
Thank you. Friends, we have now the panel discussion, and the panel discussion is again on NexGen banking, lending, credit appraisal, and as I said in the opening, this is going to be a day on which we are looking on technology, how the banks are going to work, how fintechs are going to work in future, and the driver will be the technology. So we thought that this day, second day, we'll have all the session relating to the future banking as well as technology, and we have eminent panelists from the their different field, and we have the moderator also who is expert on this areas of next gen banking as well as credit appraisal. I'll request Rahul Javeri to first introduce and then kick off this session. Rahul, over to you.
Thank you, Ketan bhai. Just to check, has Lokesh joined?
I'll take care. I'll talk to him. You can start off.
I'll start off.
Hey,
thank you.
Hey guys, just a check. You're able to hear me, right?
Yes, Mr. Vikas.
Okay. Good.
Yeah, Vikas ji, we can hear you.
Thanks.
Perfect. Welcome everyone for the last session for our banking and banking summit for the current year. It has been going a good 2 days of webinar and good learnings for all of us. So welcome to the last session. So as Ketan bhai mentioned, so this is on the next gen banking, primarily focusing on the digital lending, credit appraisal, and credit monitoring. So we have 3 panel members. So I'll first introduce Mr. Chandan. So Chandan is a senior risk professional with more than 18 years of experience in risk management for retail loan portfolios, and he also has expertise in terms of the operational risk, fraud risk, AML risk, and compliance risk. He is currently heading the risk and credit unit for the Flexiloans Ops, and he has in-depth experience in terms of the digital products and processes, partnership with new age fintechs, etc. So that's a background. He has almost 18 years of experience. Other panelist member we have is Mr. Vikas Kumar. He is a CTO and co-founder of LoanTap, has over 16 years of experience in the software industry, with majority of it as a CTO of Brain Visa, which he co-founded along with his partners in 2000. Post Brain Visa, he has been advising startups and small businesses like Mobicon Technologies, SME Networks Private Limited, wpoets.com, etc. He has also co-authored a book titled Startups Finding Funding, which talks about 20 startups and how they raised funds in 20 unique ways. His specialties are strategies, technologies, expert advisor, investor, and fitness. The third panel member we have is Mr. Lokesh. Lokesh is a well-qualified and a seasoned professional with extensive international experience and diversified exposure. Lokesh is dedicated to provide the world-class services to the banking and financial services industry. Currently, he is serving as a chairman and managing director on the board of Mizuho Global Services India Private Limited. Lokesh is responsible to set up the global shared service centers for the bank. Previously, he served as a managing director and chief operating officer for Societe Generale Bank, which is a French multinational bank in India. This panel will be moderated by Mr. Dnyanesh Pandit. Dnyanesh is a managing director in the financial services and advisory practice of Protiviti India. He has over 20 years of experience in governance, risk, and compliance across banks, NBFCs, insurance companies. He has gained experience assisting companies across India, USA, Europe, Middle East, and Southeast Asia. Danish experience is spread across to public and private sector companies. With this quick background of each of the panel member, I would hand it over to Dnyanesh to kickstart the whole discussion.
Thank you so much, Rahul. Just a quick check if you are able to hear me properly.
Yes.
Yeah.
Perfect. Great. I think exciting session ahead of us. Interesting panel members as well, with a diverse set of background specifically around this topic today. I'm personally excited because this is a topic very close to my heart, and I've seen this credit appraisal and overall digital technologies being transformed in the last few years. But before we begin into our panel discussion, maybe I'll set a little bit of a background, right? And at the cost of sounding a bit negative right at the beginning of the session, just to kind of lay down the foundation, the traditional finance and lending systems were actually not very inclusive in that sense. Customer experience was not very very exciting. It was not very it was very cumbersome in that sense. The borrowers were left at the discretion of the lenders because there were not many facilities, there were not many options, there were not many workarounds that you could kind of get lending facilities as well. A lot of people, as a result of this, were left out because of the way the entire appraisal and the lending processes were there in the earlier period. In the last few years, there have been tons of technology innovations, right? And with that came in efficiency, with that came productivity, with that came quality, with that came inclusion, which is a big factor as well. Competitiveness as well, given the fact that there are so many players that kind of enter this place, and ease of access. And just to kind of give you a reference point, when I say ease of access, just as an example, one of the RBI reports last year talked about 1,100 apps on for user mobile apps for users from a lending perspective. This is just the beginning of the revolution, right? I mean, when we talk about ease of access. With this, maybe we'll start off with a few questions for our panel members. Maybe the first question is a slightly broader one, and I'll maybe pass it on to Vikas to start with, and then I'll have Chandan and Lokesh to kind of contribute as well. Vikas, your thoughts in terms of how have you seen the evolution of the entire credit appraisal cycles and the lending activities in the financial services?
So it's interesting. When we started, 2016 odd, predominantly everybody was appraising in the same way. So you would use the bank statements, you would use the CIBIL scores, you would have a standard cutoff 650, 700, some cutoff, right? If there are n number of defaults in the bank statement, it was practically a cookie cutter, right? There was no then in about 2017, 18 and all, people tried alternate data. So they started doing very amazing things, like depending on how much battery you use, they would want to lend on that, right? All of that also failed because it didn't make sense. So people started like, if you have enough friends on Facebook, then I'll lend you, right? Those were like absolutely illogical, and they're still illogical, right? So there was that whole phase. And then finally, somewhere, I think during the COVID phase and in the last 1 year, especially with the rise of BNPL for consumers, people figured out that there's already a lot of data available, genuine data with market providers. So if you go to a two-wheeler company, he already has information about how much time the two-wheeler has been maintained, when was it last maintained, right? Is he filling the insurance on time? Right. So you have a lot of data already available, deep data. You have GST data, you have ITR returns data. They're obvious, but you have a lot of unobvious data, like how many times does somebody order in Zomato? How many times does somebody order in Swiggy? Now those data, when put together, start giving you a lot of deeper insights, because this data is quite deep. So a Zomato can potentially provide you a 2-year data, a 3-year data of a person. If for 3 years the same person has ordered from the same place, it means that that guy is stable. If he has ordered in the same office, that means he has not left his job, right? You can't fake a Zomato delivery per se, right? He's not going and pretending to send it to an office and it doesn't exist in the office. You can fake an email ID, but you can't fake a Zomato delivery. So now what has happened in the credit appraisal, people are now using this data which is already available with various partners, tying up, getting this rich data and appraising based on this data. And what we also figured out over time, that CIBIL data and all is actually not very valuable, right? The default rate in people above 750 CIBIL and the default rate at, let's say, 650 to 750 is not significantly different. It's not different enough to really, stop lending to 650 to 750 range. So all of those data started becoming not really valuable. So you obviously still supplement with the accessible data and banking data. But now what we are doing is we are using alternate data with providers who have long history, right? Wallet data, Paytm, all of this data has long history, and you can get back to years of data if you want. And all of this data is genuine. So the mobile number with Paytm of yours is not wrong. The mobile number with GPay is not wrong. The mobile number with Aadhaar is definitely wrong. So most of the people, you will be surprised, their Aadhaar card, they've used mobile of their sister, brother, father, mother, right? And not their actual mobile number. So it becomes very difficult to track people. But everybody has the correct mobile number with Zomato, with Paytm, with the two-wheeler guy. All of that data is genuine. Right. All the shopping data, Flipkart, Amazon, all that data is genuine. So
True, I think
we have now, pardon?
Sorry, go ahead. Go ahead.
So that's it. So what I was saying is that what we have now seeing is a blend of proprietary data lying with a lot of partners and basic financial data like the bank statements, the salary statements. That also we are trying to pull from generic sources like PF. An ITR return gives you salary data. So a lot of the generic data rather than specific data, and club that and create a credit appraisal structure. And then you can put an AI layer on top of it, which allows you to create a blend of. So on one side you have AI data, on the other side you have proprietary data, which is 100% genuine, and on the third you have some basic financial data. I think that's the three things which you will see happening in credit appraisal. This is the way it's going forward.
Interesting perspective, Vikas. I think I picked up two specific ones, maybe off topic right now, but you talked about the traditional way of appraisal using CIBIL score, etc. One is obviously the distance between two CIBIL scores and the potential to change the lending pattern. The other aspect is also the accuracy or the updatedness, if I can use that word, of the data itself, right? With surrogate data like you mentioned, like Zomato and all of that usage, it's more live, it's more detailed, it's more accurate, so to speak. Definitely, and I think these
across bureaus also the difference of data is just too high. So the same data in Equifax will be totally different, and in CIBIL will be totally different.
Absolutely. The other thought that I was running in my mind was you mentioned about Zomato, Swiggy, and the likes of other kind of ancillary customer service kind of apps, which are also now actually going into the NBFC space. They are going for licenses to kind of start NBFC. They realize the potential of data, I believe. They realize the potential that the market has and the lending space. I think they are also going for NBFC licenses.
So most of these guys, incidentally, Amazon also tried. Most of them have not been able to procure NBFC licenses because there's just too much conflict of interest. And at the end, now they will actually get out of NBFC licenses. They're happy, and they can actually earn more just by providing leads and providing data. So data actually is more valuable than having an NBFC. So you will see most of these guys, except for the B2B space like Udaan and all, they will not form NBFC. Zomato will never form an NBFC. It just doesn't make sense anymore. The data is much more valuable to him than the regulatory compliances, and the compliances of India are so tough in an NBFC. It's not worth the effort for a company like Zomato.
True that. Maybe I'll pass it on to Chandan for his thoughts on this point.
Yeah, thanks, Dnyanesh. What I felt when I started my career back in 2003, where the term digital lending was just not there around, right? It was physical lending, and you set the context pretty rightly. I think we have seen a number of changes, right? Innumerable number of changes that have happened. I mean, the most critical one that I have seen in last 17-18 years is that earlier when I started my career, there used to be this physical file with a lot of file folders lying on your table all the time. You go to the office and start opening those files, going through. Those files have just disappeared today, right? You go to the table, it's a clean table. You just have to
Yeah.
log into the system, access files. So optically, that's the, I mean, the physical file has vanished faster than the articles. So it's all gone today. That's, that is my first thing. And secondly, those days getting a loan was more of a luck factor, right? You have to really wait for months together, and you don't know whether you'll get a loan. There is less than 20% chances for you to get a loan. Today, we are looking at getting a loan just by a click, right? Uh, the expectation of the customer is such that if I'm applying for a loan, I need to get a clarity if I'm getting a loan on maybe by today, end of the day, or max by tomorrow. Anything beyond tomorrow is now considered a deal. And that's a paradigm shift in terms of our loan approval. Third, I think is those days it was more intuitive. The credit appraisal was more intuitive. Today it's more informative, right? We didn't have data. Uh, the credit guys used to take their own call. The customer is going to pay.
Sorry, Chandan, I'm not sure whether it's me, but I think there is some background.
I think Vikas.
Yeah.
I think the third thing that I was just talking about, it is a shift from the intuitive credit appraisal to a data-driven informative credit appraisal. We have a whole lot of data. We just spoke about, Vikas talked about the data availability. That has made the entire process, of course, the TAT has come down, and the accuracy of the data, right, and whatever I'm reading is now is like immensely shifted now. The if I was going wrong in say X percentage out of the 100 customers, now it has come down by a real big margin. So I think that is the third one. Fourth, I feel earlier when any company wanted to really expand their business, it was more of a branch model. Suppose I want to go and open a particular location for my lending. I have to figure out who is the underwriter guy, who is the collection guy, who is the sales guy to be based out of that location. They will source, they will meet the customer, so on and so forth. It was a branch-based model. In hindsight, if you look at this, I mean, that was definitely not the right model to kind of grow exponentially high, because you can't just keep opening in all the locations that you're operating. Today, Flexiloan, we operate just in Bombay, and we cater to more than 300 locations across the country. That has happened because we have completely done away with the branch modeling. There is only centralized. The entire credit team is centralized, based out of Bombay, and thanks to all this tech and data-driven thing, that sitting here we can access actually everything. So, to me, these 4 or 5 things really changes the. Of course, apart from the nitty-gritty of how the underwriting actually happens, with a lot of integrations with 4 bureaus now available, the data coming from 4 bureaus is like really rich. I mean, to what extent you can consume, what all you need to do away with, all those things were not as handy maybe 10 years back. Most of these changes have happened in last 7 to 8 years, and this is where we are today.
Great, thanks. Thanks for an interesting perspective in terms of the transition that we've seen over the last 10 years or so. Lokesh, maybe on this question or this point, maybe a few parting thoughts before we move to the next one.
Yeah, certainly. Am I audible?
Yeah.
Okay, thank you very much. So this is a very interesting topic, and I've seen both the sides, the retail banking side as well as corporate banking side, and now I'm managing the back-end side of the lending in credit risk. So I have seen definitely a huge transformation or evolution on credit processes over last 2 decades, I would say. And as one of the points Chandan just mentioned, centralization or industrialization of this process has been very important factor. There has been a transformation by process in the credit appraisal, by products, by the nature of clients, by the nature of risk, by regulations, and by the kind of reportings that have been implemented either by banks internally or by the regulators around the world. So these kind of things have definitely transformed the way we are doing credit appraisal now. Several reportings, so I can go one by one, but that can be a bit lengthy. Just to summarize, I would say the overall environment of credit process has improved over a period of time. I would say over last 2 decades and progressively in last a few years recently. Even from the corporate governance point of view, this is more from the corporate side. The corporate governance point of view, now we see that MCA is much better organized and digitized as compared to what it used to be 10 years ago or 20 years ago. Now there is much more discipline enforced on corporate to file their annual returns, financials, and then the banks are also getting financials on timely basis. And banks are also equipped to centralize this credit process. And instead of, there was a day when branch used to do the credit appraisal, but now it is centralized in banks. And even from the banks, it is now outsourced to their captive entities and KPOs, which are now doing the credit processing. And of course, the decision is taken by the bank in terms of final credit granting, but quite a few background work on credit analysis and risk and preparation of the rating is outsourced to the KPOs. By products also, there have been several products now in the market as compared to what it used to be. On the corporate side, it is a bit complex because when we do an appraisal, it is not done for just one product, but the credit appraisal is done for the entire relationship as such, which touches several products. It could be a market product, including, let's say, any derivative lines. In that also, we identify which currencies or which products we can offer. Simple derivatives or complex derivatives. We can identify trade finance lines. We can identify the term loan, working capital, or several other products that we need to assess on the credit appraisal. Then we also need to identify the corporate structure, which can be complex sometimes. So there can be a holding subsidiary relationship. There can be a global relationship with associate companies. We need to identify the ultimate beneficiaries. So it can be fairly complex. What the banks have now deployed is also, at times the credit process in banks can take fairly long time on corporate side. So we have also moved into digitization, and we are trying to take as much information from online platforms as possible to minimize taking the information from clients. And we are reaching out to our clients only for those information that cannot be taken from online platforms that is not publicly available. But definitely, I would say we have also deployed some robotics to automate the process. So let's say once we take a financial, even if it is signed PDF, we put this into OCR system and then we extract the information and put this into our database, and then we can automatically calculate the rating. So those kind of transformation have definitely happened. From regulatory perspective also, there have been several changes in regulation on the credit process. And now we have a willful defaulter list, we have credit reporting, we have CBIL. So several platforms on which we have to do the parameters also have have undergone change. So there are several things. Maybe we can discuss as we go. But that's what I would like to mention. Thank you.
Thanks so much, Lokesh. I think you touched upon a few interesting topics. And you talked about risk as well. Maybe I'll hold on to that one for a few minutes before we pick up the next one. I think across the feedback that you've shared so far, I think one common theme that I noticed was the importance of different parameters that are used from a credit appraisal perspective. there are so many different surrogates. There are so many different data points that Vikas, you, Chandan, and even Lokesh, you mentioned about. So the question is, what is the right balance, right? I mean, when you have so much data, you sometimes it's like the classic terminology that they use, right? Paralysis of analysis. How much data do you really need to analyze to get to what you really need to do? So, what is the right balance as per you? Maybe we'll start with Chandan, you, in terms of doing a credit appraisal.
My view would be, see, typically we have last 7-8 years, we have moved away from the traditional data sets, which, I mean, what I call a traditional data set is income details, financials, banking, and maybe bureau to a large extent, because bureau data has been with us for about 2 decades now, right? So first of all, let's understand why we wanted to move away from the traditional data. Because we eventually figured out that traditional data only covers a percentage of the customer base that you want to really target. If you want to go beyond that circle, and you really don't have visibility of the data point on the customer, then you are again back to that traditional way of intuitively deciding whether this customer would, or this portfolio of the customer would go right or wrong, right? The whole point of this moving away is because if I have to do that value addition in the segment that I have not been adding value, I really need to have some data points so that my judgment, my underwriting judgment is going to be accurate. And that's why we moved away from the traditional data. Fortunately, the amount of digital transformation that country has seen, we have a whole lot of data points that we have seen. Vikas was talking about the data points like utility bill, mobile bill, mobile data. You have social media footprint. You have digital media footprint. I mean, you name it, and you have the data points. Would this help? My answer is, of course, it does help, because more data you have, you will be able to you have more information about the customer, and credit is about knowing more about the customer and then taking the right call. Is there a right mix of how much data you want to have? I completely agree with you. More of analysis leads to paralysis. But I think what is more important than that is just having the data, because today the market is flooded with data, right? Just having the data would not help as long as you can figure out what is the relevant data that you need out of that entire lot. Today it is, you have a device data, but you really don't know whether that device data is really kind of helping you to forecast the loss of that portfolio in maybe next 1 year, 3 years time. What I've understood is that most of this data actually do not add value. You just have those data, and more of data creates a lot of chaos. And with the new rules coming, there will be a lot of responsibility on the lender side to how to keep those data and all that thing. It would be, there is no right mix, or there is no right number of parameters that we should factor to decide as to whether this is the optimum number or not. Depending on the target segment that you want to go, just limit yourself to only to those data points which you think will add value. It's a myth that more data would actually help. It is not the case. It will actually create more chaos than anything. Like Vikas was just pointing out, right? We have data from Zomato, Swiggy, so many data points, and all those are actually valid. They're factually right. As long as I can correlate that data point to my book, and I see some of those data points are correlating, then that's about it. Ignore rest, stick to them, and those will perform over a period of time exceedingly well. That's about it. So as long as you can create that balance, that's it. You have done the.
Yeah, I think he's absolutely right. You have just too much data. I think the key is to, out of these hundreds of data, select the 2-3 pieces of data which is important. And in fact, anything beyond even 5-10 pieces of data is chaos. You just have to have a minimum set of data, relevant data for that use case, and use that. All the other data is just noise. You have to get to just few pieces of data. I totally agree on that.
True. Lokesh, your thoughts before we move to the next one?
Yeah, so slightly differently from a banker's perspective, lending is one of the main businesses for banks. And in the history of banks, credit risk is one of the oldest identified risks which the banks have been managing, and it's one of the significant risks that bank is supposed to manage. So in terms of parameters, I've spent some time with some really experienced bankers from nationalized banks and other private banks. What I've learned from the chief risk officers is that there are two most important parameters, and they will never change ever in the history of credit. These two important parameters are very generic, very basic, because basics will never change. Two generic parameters are ultimately everything will boil down to them. These two parameters. The first one is ability to pay the customer, ability to pay. The second one is willingness to pay. So as long as a bank or a lender can ascertain the ability to pay and willingness to pay, it's a good credit. Now, there are technologies and systems and processes, the whole wisdom to identify and assess and measure and monitor the ability to pay. But it is very difficult to identify willingness to pay, because that's about integrity and it can change. Now, that's one point. Now, just from the other point of view, there is an international framework of risk management prescribed by Basel Committee of Switzerland. So they talk about the stability of banking system, financial system around the world. They also talk about the capital adequacy in the banking system, because credit risk can cause huge disruption in banking internationally. So this Basel norm also speak about the capital adequacy, and one of the stream in contributing to capital adequacy is credit risk. Now, based on these guidelines, every central regulator in the country have prescribed various regulations and guidelines to manage credit risk, and various parameters are defined in those regulations. So local banks definitely have to follow those regulations as essential parameters, but they also have their own credit policies, and the credit policy defines parameters for lending based on the risk appetite of that organization, risk appetite of that bank. So these are general guidelines. After that, then there are credit authorities which moderate the credit portfolio of the organization from time to time, depending upon the risk appetite. So sometimes they want to, increase the lending on one product and decrease on the other product, and they also moderate the pricing accordingly, and they define the criteria and change the parameters of lending accordingly. So this is how the parameters of lending are coming from. I would say it is the international framework, then the central bank framework, then the framework of credit policies, and then the credit authorities. Then it depends upon, let's say, if credit authority has approved a program lending, then the parameters are defined in the program lending. So it is more in the retail space that, okay, if somebody has to be given a credit card, as long as he scores these 10 or 8 out of 10 points, he can get a credit card with so and so limit.
That's interesting perspective. I think you also brought in the thought of risk in this, which was one of the points that I picked up on your last comment. And as cliche as it may sound, with great power comes great responsibility. With great innovation comes greater risks, right? And with RBI's focus on financial inclusion, focus on innovative products, there is tremendous increase in the first-time credit or first-time borrowers in the financial system. Maybe Lokesh, your thoughts in terms of when we are lending to people who are new to credit, how do you see that as a risk to the portfolio? And one, and secondly, are there any countermeasures that can be taken to kind of counter something like this, especially from a first to credit people, borrowers? Because maybe we'll hear your thoughts as well on this one.
See, first of all, the bank needs to have risk appetite for such borrowers. it is much prevalent on the retail side, but when it comes to corporate side, even the first time borrower has to have some track record and credibility established, some cash flows and some security before the first time lending can happen. And one of the, the one step before credit is KYC and due diligence. So it is a precondition. Unless the KYC is established and due diligence is performed on the promoters, ultimate beneficiaries, the key management personnel, then the second step comes the credit appraisal. And of course, the first time credit appraisal will be a bit more rigorous than the second time.
Sure. Vikas, maybe your thoughts on this first time credit, first time borrowers and the risk associated to the portfolio. You're on mute, Vikas.
Yeah. So it's interesting. See, typically what we are seeing is the first time borrowers are entering the system through three, or that's what we see in the future also, three clear blocks. One is through BNPL for consumer space. So somebody buys something on Amazon and then converts it into 3 EMIs. The other is two-wheelers and electric two-wheelers. So we have unlimited two-wheelers in India, and because it's also a secured asset and the amounts are small, that's a great entry point for first-time borrowers. And the third is short-term credit to SMEs. So like a 7-day loan or a 14-day loan for working capital. So these are the three big ways people are entering the system. Now the challenge when people enter the system in these three ways is that the ticket size is so small that you can't do a rigorous appraisal. So somebody in Amazon is buying 2,000 rupees worth something. You don't have the time, the money, the effort, or any parameters by which you can really appraise him to that level. Similarly, we typically for 7-day loan, an SME will borrow 200 rupees. Right? That's a start journey. Now, what do I do in the appraisal process? So, what we've realized that most of the initial people will join at very small charges, small amounts, typically less than, let's say, 10,000-20,000 rupees. And therefore, you need now a framework where you sort of let this go, or create a structure by which you can, appraise such small amounts. There is no CIBIL anyways, and if you actually had the CIBIL, it is not valuable. As a sir put, the willingness to pay, right? Now, there's nothing to judge in a willingness to pay for 10,000 rupees. The ability to pay also you can't judge for 5,000 rupees. Everybody has the ability to pay back 5,000 rupees. So basically, it's difficult to appraise, but this is the way new to credit are coming in. The first, typically nobody takes a home loan as this first loan, right? So typically these are the 3-4 ways people enter the system, or it could be a credit card, where he has a, let's say, a 10,000, 20,000. So one of the company's pay point is getting people into the credit system by giving them PPIs of 5,000 rupees. So none of these give an opportunity to really evaluate rigorously. So that's why, I love the Zomato data and data like that, because those can most probably be used. So if somebody has been using Zomato for 3 months, and then if he comes and asks you for 5,000 rupees, you are, hey, at least he has been in one place for 3 months. Not too bad, right? So it's tough, and that's why banks and all have shied away a bit from the BNPL for consumers, from electric two-wheelers, all that, because you can't really do a formal appraisal. So NTC, we will not see formal appraisal happening. It's not possible, except for very, very specific scenarios where they're going for a ticket size above. Anything below 50,000 is difficult to appraise.
And just to kind of stick with that thought, Vikas, we've seen instances of frauds and news reports around frauds in the digital lending space. What is your perspective on that? And is there a countermeasure to kind of manage this kind of a situation? Because fraud will exist, at the end of the day, it's I think risk of doing business at the end of the day. Right?
Yeah, so you're absolutely right. And to be very honest, there is a very specific problem India has, and that is willingness to pay. Whether we accept it or not, a large segment of India does not have a willingness to pay, right? So when we talk to people, if you have given a loan to somebody in a community and he's safe in that community, he will come straight on your face and say, I'm not going to pay you back. Do whatever you feel like. So this is, I think, something very specific to India. This willingness to pay is a challenge, and therefore fraud is quite prevalent, and it will increase rather than decrease. So yesterday only one of my friends had being scammed by this company promising to deliver in time, and then they saying that the UPI didn't go through, so pay again. That typical scamming thing, right? So the fraud is not going to go down. What people are doing is actually very simple, just building the cost of fraud into the system. Are people really solving the fraud issue? I don't think so, because most of even the tools like Hunter and all, which give you fraud data, the fraud data is very minuscule, very costly. The cost of getting the fraud data is more than the cost of the fraud. For 5,000 rupees fraud, you're going to lose 5,000 rupees, but you're not going to pay 50 lakh rupees for a system to figure out a fraud at 5,000 rupees. No. So the only way now what people are using, so there are only two ways: A, build the cost in, or B, the alternative data you are using. So the anchor, so when you're working with, let's say, a Paytm, or you're working with, let's say, a creditor who's into used two-wheeler, there is an anchor there, and the person you're giving loan to owes something to that anchor. So like, for example, we work in the SME space. That SME guy is buying products from Big Basket. We work with Big Basket, and he's been buying from Big Basket for 3 months, 6 months. He's not going to screw up his Big Basket relationship just to not pay you the 10,000 rupees, because the Big Basket relationship to him is more important, right? He will not disappear out of WhatsApp to default you from 5,000 rupees, because his WhatsApp relationship is much more important. Yeah. So if you're able to find people who and you can find an anchor whose relationship is very important to this person, then you can go ahead with lending and believe that he will only not pay you if he no more has ability to pay, and the willingness to pay has gone away. That you can take care of by having anchors in the system. So thanks for defining those two terms, willingness to pay and ability to pay. I think that was brilliantly put, because that gives the right perspective and it helps us define terms very easily, right? So ability to pay, you cannot take care of. Willingness to pay, by using anchors, by creating secondary data or surrogate data, you can to some extent mitigate that risk. But beyond that, you just build into it. So I know people who have built it in, and SMEs, typically the short-term loans work at IRRs of 28, 30, 32%. The prime reason is because of the default rate. So we have already built it. In US, you get loans at very low rates. And India, NBFCs are lending at 18, 20%, 24%, 30%, while banks are lending at 12%. The difference is predominantly risk, right? The cost of capital is also, to a large extent, the differences are becoming controlled. So the rest of the gap can only be justified by the fact that NBFCs are taking more risk. So they are putting in more interest rate. So we are covering our fraud risk to some extent because of that.
Vikas, you are absolutely right in what you said. Definitely in retail space, at least, the cost of fraud is built into the pricing. At the same time, most of the banks, I have worked in several banks and seen that they have a fraud containment unit or a risk surveillance unit, and they deploy very advanced level of software and data to identify and detect fraud and contain the fraud at a very early stage. And now with the advancement of technology, the moment transaction is done, instantaneously the message is going to the customer. And now banks are also giving customers kind of an assurance that if the fraud is reported within few hours, then responsibility goes back to the bank to detect it and restore it. So definitely, banks are also taking a lot of steps to monitor this and curtail this down. Coming back to the corporate side, as you just said, definitely willingness to pay is the issue. That's the challenge. But because of this challenge, we cannot stop doing business. So there are ways and means of controlling and trying to mitigate that risk or minimizing that risk. This is the challenge in credit assessment. So even if the client may at times turn out not willing to pay, we should still be able to recover something which is good enough. Or there are ways to to get the clients to pay. That's part of the credit assessment process at banks. Thank you. Now, I think on that respect, we don't have enough time, but insolvency process is also, one of the initiative in that regard.
Thanks, Lokesh. Thanks, Lokesh and Vikas, for this. I think if we talk about innovation, right? We talked about innovation in product. We talked about innovation in process. Maybe Chandan, your thoughts around innovation, possibilities of innovation in the other scheme of things within the credit appraisal and lending process.
I think if I look back what credit was 15 years back and what it is today, both are not comparable. We have really done a paradigm shift. So from a customer point of view, I think the whole process of automation, digitalization, I think everything has helped in terms of getting accurate decision, getting it on time. But if I look from here and we simply compare where today India is some of the developed countries in the Western world, I see that we have covered really less. I mean, we have a lot of things to be done. If you ask me the areas where we have scope of automation, I think it is across the departments, across processes. There is huge scope of automation, innovation coming in. Just to give a small idea, like for example, today, at least in the retail space, more so in the corporate space, when the customer applies and everything goes through, the final touch point is that somebody from the credit would speak to the customer, right? Then they understand the business, just to understand the business, how it kind of how customer is aware, how is running this, so some clarifications before we finally say yes or no to the customer. Today that entire process is a manual process, in the sense the credit guy has to really call, and maybe on a video call today, and there was a physical call till 2020 beginning. If I have to just think wild, why can't this entire process be automated? Why can't I have an AI system calling the customer, depending upon the answers what customer is going to give, this system is going to throw those questions. It's on a recorded line, then it scores the customer and throws back the result along the recording. Today this process is little far away, but I'm just saying the kind of opportunity we have still left out in the automations phase. This is just one example. For example, today look at automation. There is more automation in the lower end of the ticket size, right? When you're looking at our ticket size of sub 1 lakhs or 50,000, because the cost of it, I mean, the economics would not just fit in. We put everything in the automation, in the algorithm based underwriting. As we go above a particular ticket size, there is more and more manual thing, and hence there is an increased stat and all that thing. I think that there's a huge scope of kind of bringing in some automation process where, for example, today we really don't have a mechanism to figure out the physical existence of the customer. There are mechanisms, but it is prone to error. There are a lot of errors coming in. So we typically rely on some agency visiting the customer, checking them on the businesses, residents, coming back with a report. We have traveled some miles in terms of automating that, but I think there is a huge scope to kind of figure out the customer really exists. There is a real business running. There is a real cash flow assessment. All those reality checks today, most of them are done through a physical visit. It can be automated to a large extent. I think just to give some example, it is, but across departments, across value streams, there is huge scope of automation.
Chandan, when you were talking about AI-based conversation with the customer and recording the conversation from a KYC, etc. perspective, again, an off-topic, off-track experience that I just would like to share. Recently, we, as part of the recruitment cycles, I saw one news article which talked about softwares which actually pose as different individuals, and they kind of give their interviews and they get selected, and then a lot of challenges around that. Just from the hangover from the risk conversation that we just had a few minutes back, do you think this could be a big challenge as well?
I think, see, once you go from point X to the point Y, which is a big shift, it will always have bigger challenges in that way. But the whole fun is cracking this, right? How do we do it with accuracy? I mean, some years back, we couldn't figure out, none of us could think that what customer is using on the mobile, the device data, the SMS scripting, all those, no one could even think of a few years back. Today, it's like, it's a BAU data. Everyone has this, right? So the way we are evolving, thanks to the entire tech evolvence, I think there is huge, and in this direction, so look at, there is something called as a robocalling. There is a robo texting, right? Which was not the thing a few years back, just few years back. Today, robocalling is like everybody's job, right? Every company has that process for small ticket size. There is no human actually calling. There's a robocalling, there is a robo dialer happening. You speak to the customer, get those things. But it can only do as much today because of the whatever issues that we are facing. I'm sure there are developments happening, and I don't think the way we are advancing, it's not far off from here. That in 2-3 years time, which actually literally click and loan comes in. Just that we need to have a lot of structured data around, and already the government systems, I think everyone is working towards it.
And some amount of monitoring. Maybe we'll hold on to the monitoring part for a little later. But maybe Vikas, your thoughts before we move into the next one.
Not much. I just agree. I think let's go ahead. Practically everything's got covered.
Maybe
So
if I can just make, can I make a quick comment about innovation?
Yeah.
So I would like to mention that the innovation in lending is also a consequence of innovation on the payments space. And if we really see the payment platforms today, the way we have now various different platforms on digital payments, had this not been there, then probably the innovation on lending would not have been there as much as we see today. And regulators also in India have done so much of transformation around the payment systems in India. There was a change in the payments related statute or payments related regulations. Reserve Bank of India has provided now the National Payments System company, and several payment platforms are now allowed, and digital instruments are allowed. So I think the regulation is also here, which is enabling lenders to make various innovations on the payments market. On the product side also, various new products have come in terms of lending. So, and this has got also the regulatory support. I keep mentioning the regulation because this the lending space is heavily regulated in India. So we can't get into a lending activity without having the regulatory presence. One of the new products which was recently launched in the corporate segment is external benchmark linked rates. So there have been transformation on the lending space. So there was a time when we used to have prime lending rates, then we moved into base rate based loans, and now we have moved into the external benchmark linked loans as well. There have been several innovations on the retail on the program lending side as well. But now I heard that the government may be also willing to open up the bond market for retail. Like the currency market is also open for retail. So those kind of new innovations can happen. And CCIL is out, I think, allowing retail investors to also start dealing in the FX market directly without going through the brokers or banks. On trade finance also, there are innovations happening. Some of the banks are now getting into blockchain to digitize the trade finance business. There is a associate company of earlier associated company of Swift. So Swift is kind of a worldwide payment gateway, and they started with a company, and now then disassociated this. This is called Bolero platform, and this is providing digitization of the whole trade finance business. Some banks are already onboarded on it. And once these kind of digital platforms become quite common, then the working capital lending and the working capital finance can become much more efficient than it is today, because the whole business is around physical movement of documents and goods. So once the physical movement of documents becomes digital movement of documents, it can be fairly efficient and transparent and better controlled. In terms of innovations, some of the Indian banks that I worked with have been very, very innovative and aggressive in the market, and there have been several products, launched even in the Indian market. There may be several innovation on the restructuring piece, securitization piece, structured products, and insolvency market as well. On the process side, several banks are now deploying robotics, AI, AML, ML, and various automation strategies to right from the time they receive the financials from the company till the time they actually grant the credit approval. So that way, there have been quite a few transformations around this appraisal process on innovation.
Thanks, Lokesh. Deeper perspective from a banker. Rahul, how many minutes do we have more? We've got a few questions popping up in the chat box. I just thought I'd...
So as such, the cutoff is at 12:30. So we may have to give
Okay, so
a couple of minutes to the...
Yeah, so we got about 10 minutes.
Yes.
Yeah, so there's a question that has popped up on the chat box. It goes, how do we address data privacy against the background of alternate data? I don't know if anybody would like to go first.
Yeah, so that's an interesting question, and I think India has been trying to create privacy rules and norms. But if you look at it, all the data which you're giving, most of the data you're giving willingly, right? And most of the data is now tracked to the level unimaginable. So, for example, I was just traveling to Mumbai, and I realized that now every place I travel, the FASTag knows where I've traveled.
Yeah.
Right. So the amount of data we are giving out, see, we get scared of Google, that Google is taking away our data. But at the end, if you look at it, every split second, so if I book a Uber, right? So you know when I booked, where I have gone. When I cross the FASTag, you know where I crossed. Restaurant I paid through UPI, you know which restaurant I went. It is possible now to track anybody to a unbelievable level. How do you remove this data anymore? So if the fintech takes, let's say, for giving a loan, 1/100th or 1,000th of the data you have revealed, it's not going to change much. So even if you regulate and say, okay, prevent, a bank from taking more privacy data. Just imagine when we check into a hotel, we give our Aadhaar card and we are saying Aadhaar is confidential data. All the hotels have all the Aadhaar cards of everybody you imagine, and they take a scan copy also of it. So your data is just too much of data is out there. So regulating one entity in the system will not make a difference anyways. So most probably this becomes a bigger question to ask is that, hey, can we prevent all the food guys, all the FASTag? Why does FASTag not remove my data after I have paid? And why does it even want the data? So once you start looking at it, Uber, the amount of data collected is so huge that it's no more possible to eliminate a little part of data and feel happy about it. So either we look at it as a much bigger thing and get all the entities to stop collecting data, or we just live with the fact that our lives are no more private. But we are sharing just too much data. There's nothing much to do about it.
So true. I think you mentioned, sorry, Chandan, just one thought before I hand it over to you. Because you mentioned about willingly sharing data. I think I have a slightly different view. I think people don't know that they're sharing all this data. I mean, they are aware, they're conscious, but it's not, they're not sure whether they are willingly saying, okay, I want to share this data or not. So that's, I think it's somewhere to do with consciously accepting the fact.
Yeah, I agree. But take a case, if you go to a restaurant and they're saying, hey, we are having a raffle and put in your visiting card. Thousands of people are willing to put their visiting cards there. The people who are really worried about privacy is most probably 1%. The people who are willing to give away their privacy for 500 rupees is 99%.
And we've been getting data. We've been getting data in the secondary market as well, right? I mean, you pay some amount and you get
primary, secondary. It is unbelievable. There is no data which is not available, right? So personally, if you ask, I've resigned to the fact that now I'm totally discoverable, right? It is no more possible to hide data.
Vikas, just a comment. So taking this question, how to protect this data, I would rather like to clarify whether this question is for the user or for the lender. So if the question is for lender, then I'm sure every lender has processes to protect it.
Oh, of course. That goes by when I'm protecting the data I have, obviously.
So, but when it comes to user, then it is about the awareness of the user on how user is protecting its own data.
Really, I think this is a much bigger question and most probably needs a separate discussion altogether about privacy. Wrong forum, most probably.
Chandan, you were saying something when I cut you off. Sorry about that.
No, I was just thinking. See, GDPR has been around for some time, right? It is one of the most complex rules, which is now every country is kind of aspiring to kind of get compliant. We are just about implementing PDP. That's regulation is around the corner. So I think regulatory compliance is the regulators forcing it on us is one side of the story. But I think where it all starts, as I think Vikas was touching upon that point, is that today when I go to any place and I share my PI information, so I should be very aware as to why I'm giving, who I'm giving, and if I can curtail it down, right? Today we just go to hotel, they ask for any document, we just give. We don't even bother to. I mean, as simple as that, we don't even strike it off. I mean, regulatory, you are supposed to hide your Aadhaar number. We don't even do that. We just give the copy. I think the first step starts from us, from all of us, all the individual users who day in day out give our data to. I mean, whether physically, digitally is another thing. Awareness starts from here. I think then once regulation comes in, it's a more of a forcing things on us as to but that is more to do with the lender, right? Or who is having the PI data. That will also help because then we will do a regulation of kind of classifying data, keeping it only when it is necessary, then encrypting and so forth. But I think first step is and before that, at least from a lender perspective, we take a lot of measures like don't send any PI data on the email. Don't hand over a copy without any action. If the copy is lying all over the place. I think those are some sanity to take care. the basic level is done, then I think once the regulation comes in, rest will be taken care of.
Sure. Thanks. Thanks. I think like Vikas said, data privacy is something like we need a separate session for that. We've got one more question. I'm not sure whether it's a question or it's a comment, but let me read it out and then we'll see how to address that. There was a live case where a client was rejected additional personal loan because it's a frequent loan taker. However, all previous loans were timely paid. So here both parameters of willingness and ability was justified, but the loan was still rejected. So question to figure out why this has happened or why it happened. It's a specific case somebody's talking about.
So is the question that if somebody is perfect, so is it a generic question? If somebody is perfect and he has every thing right, he's ticking all the boxes, then why would a entity reject his loan? Is that what the question is towards?
Yeah, and an additional flavor to that is this. I mean, in case you've got a few loans that you've taken in the past with a good track record of paying them on time, etc., and you go for a new loan and you still get rejected, how is that fitting into the overall credit appraisal process?
No, how is that justified, or
justified.
What do you do about it?
How is that justified?
So that's actually a very simple thing. Everybody has a policy. So, for example, one of the policies which we use is the number of times somebody's made an inquiry in CIBIL. So, if we find somebody very needy, right, and he's inquired 15 times, so his CIBIL might be 780, but if he has done 10 inquiries, I will reject him because I'm scared that why is he doing so many inquiries, right? So there are many other parameters people will reject on which people don't realize that this could also be a parameter.
Sure.
Right.
Yeah.
So if today you get rejected, it could just be as pure luck as so I have AI engine and my AI engine predicts that this set of people, this person you should not be giving a loan. Right. My AI engine might have performed wrongly, but since 90% of the time my AI engine is right, I'm okay to let go the 10%. So it's quite possible that people who are absolutely have every logical right to have a loan will get rejected just because too many processes have got automated. With automation comes this biggest challenge of logical things not happening anymore.
And maybe
tech will have.
Sorry, and maybe as part of the innovation process as well, maybe an analysis of cases that are rejected could help further improvise the AI models as well. Just as a thought.
So what people are doing is they put it on Twitter, hey, this is not fair at all. Somebody looks at it at a personal level and says, okay, let's just go ahead, it looks okay. So basically the honest solution to this problem is either apply to somewhere else or badger those guys to see it physically. Because automated processes will lead to errors and good people will get rejected and bad people will get selected. It is but obvious.
Thanks, Vikas. Those were the two questions. I don't know whether Chandan and Lokesh had any thoughts on that previous question, but those are the two questions that we have.
I think the biggest challenge was because I was highlighting as we move towards automation, there is no human intelligence deciding whether to give the loan or not. So the whole issue is false positive, right? And as you rightly pointed out, more and more you do a reject analysis subsequently and you backfeed it into the system, that false positive layer is going to get thinner and thinner.
Yeah.
But every system is prone to error and there could be exceptions going off. But I think broadly, every organization, given that they are operating some different segment, targeting different audience, they would have defined a risk appetite, broadly speaking. And if the customer is not into that risk profiling, he would not get a loan. Even if the customer is otherwise good, as long as the organization kind of assessing him as a high risk customer, he would of course go out. But as I said, false positives are creating sometimes some issue, but the hope is to kind of get that layer thinner and thinner.
My very quick take is that machine intelligence is made by human, and it should never overtake the human intelligence. So there should always be a way out. There should always be a way by which, if machine fails, then the human acts. And there should always be an exception process. There should always be a process whereby if certain things are not getting processed, even though they qualify, then they go to the manual process.
So thanks, Lokesh. We don't have any more questions from the attendees, but I'm going to be a little selfish, and given the fact that we've got such interesting panelists, I'm going to throw one more question for the next 5 minutes, maybe if we use Rahul, if that's okay. We talked about innovation in multiple aspects. Maybe your credit monitoring, because I think that's an area which is also an important aspect of the entire credit life cycle. Any thoughts around innovation in credit monitoring? Okay, Chandan or Vikas, either.
So we are doing some in credit monitoring. What we have been now started, we have started using AI models, because while AI models sometimes fail in credit decisioning, in credit monitoring, at worst they'll give a wrong indication, which is quite okay in a monitoring space. So we're using now AI models to sort of predict what will be the default. So if you relook at the new CIBIL data and triangulate with the old CIBIL data and see whether this guy's suddenly taken more loans and stuff like that, and add it to the AI is able to predict if this person is going to default or not. So we're using some AI models on that, still a bit initial stages, but we believe that most of the credit monitoring will shift to AI models, which will consume, let's say, CIBIL data or consume some new other data coming in, and be able to sort of give you an idea of the willingness to pay and the ability to pay. So based on new data, AI will try to say, hey, what is the probability that he'll pay, which is basically willingness to pay and ability to pay. So I think this model will completely move to AI, the credit monitoring piece.
And given the nature of models or AI or whatever you want to call them, the more data we feed, the more intelligent or the more closer to accuracy or closer to the 99.9 percentile they kind of get to.
Yeah, so now that you have more and more data, like you could pull data from multiple CIBILs, you could put the new PF data to figure out whether there's a job change. You can actually, after 6 months, relook at the loan and get a lot of additional parameters and start feeding into the AI model. So yeah, maybe in a couple of years you will see AI models being able to predict quite well how much what will be the overall NPS in the portfolio as such.
I think this goes back into the overall credit appraisal mechanism as well, right? We talked about parameters some time back. I remember a few years ago, Grameen Bank, Bangladesh, it started lending to a specific category of individuals, but they used heavy amount of surrogate data in terms of where the person lives. Obviously, that's one of the data that we obviously collect. But the question, the additional information that they sought, top of my mind that I remember is who else is there in the family? Who else is an earning member? What is the education qualification of other members of the family, not just the lender? Right. So
all of us do that. That's quite common. We also try to figure out the family and all. That helps a lot in the willingness to pay.
Yeah. Thanks, Vikas.
I think on monitoring phase, Dnyanesh.
Yeah.
I just, if I can correlate to your last question as to years of, I mean, the scope of innovation. I think there is a very good scope of innovation here. Today, all the monitoring is, most of the monitoring is happening on a point in time basis, right? Maybe after 15 days, after 1 month, quarter, after 6 months, so on and so forth. As we move towards automation and complete through processes, customer getting onboarded on a real-time basis, I think the monitoring mechanism also has to evolve to a real-time basis. We can't really wait. I can't give a 1 month loan and wait for a quarter to figure out what that is looking like. Today, wait for us to send the data, get the data, massage the data, then see what the portfolio looking like. There is a time lag, and what is coming out to be the most critical factor is a time lag. Right? So to do that flexi, we work. Today we are spending most of the time to figure out the fact that we have now built the book. How quickly we figure out where this book is hitting now. Is the entire book is performing the way we envisaged initially, or a segment going wrong, going right? The whole analysis time today, right? Even though there is AI reading the data, there is algorithm kind of churn the data. Getting the data takes time because there are multiple sources of information you have to then read, then correlate. I feel if this patch is kind of shortened and we get the data on a little quickly and on a maybe on a weekly basis to start with, we start seeing that performance going without anyone doing anything. I think that's like a perfect portfolio monitoring space.
Very quick comment on my side. So on the monitoring side, there is a very strong push on automation of non-performing assets, and several banks were recently penalized by the regulator for non-implementation or inadequate implementation of the norms on automation of non-performing assets and their classification and reporting. Yeah. And not only the reporting of non-performing assets, but also not reporting of early warning signals. There are several red flags stipulated, and there are several early warning signals that need to be monitored by banks against their credit. There was also a recent change in the current account opening in its utilization, and several banks have been advised to monitor opening of current accounts quite carefully. There is also regulation around end use of funds, and wherever it is detected that the funds are not utilized for the purpose for which they were granted, then it becomes an issue for the banks and the regulators as well. Supervision is also happening on the rollover of short-term loans, and wherever evergreen of short-term loan renewal or over is detected, that is also regulated and monitored. So these are some of the I can see. And banks are now deploying technology to monitor these kind of things, including not only the NPA, early warning signal, but also the end user funds utilization and rollover of funds.
Very true. I think interesting comments, Lokesh, on monitoring. I think yes, the regulator has also played an important role in pushing organizations, pushing institutions deal with in a slightly aggressive manner than the traditional methods. Great. I think that's what we had for today. Interesting conversation, interesting points popped up during the conversation. I think great insights from you, Lokesh, Vikas, and Chandan. Thank you so much for.
Thank you. Thanks, guys.
Dnyanesh, thanks, Piyush. Thanks, Ketan.
Rahul, over to you.
Yeah. So thanks everyone for joining. It was really an insightful session, and I'm sure attendees also would have learned a lot of stuff in terms of the overall lending space, monitoring space, and what has changed so far and what we can expect in the future as well. So that's a quick thought from my side. Maybe Ketan, over to you. How do we on the closing of the overall summit?
Yeah. Thank you, Rahul. Before I request RCM elect Piyush to propose the very well deserved vote of thanks to this for this session, as well as for entire banking conclave and for all the attendee over here. One or two small question which came to my mind during this discussion. One, Chandan ji did mention that earlier we had branch concept, and if I want to go somewhere, I will open the branch and I will go by branch. And now sitting in Mumbai, they have some 300 places presence. So Chandan ji, RBI is monitoring this branch licenses still, and we have priority sector lending, and they every bank wants to do priority based on the requirement of RBI. So looking and hearing all of you, I think all this regulation also will require a changes, and maybe priority sector lending may. So even Lokesh ji was mentioning right now about was passing a remark. So I will request Chandan ji and Lokesh ji to comment that what will be the future of these things.
Can I take this question?
Yes, sir.
So under the Banking Regulation Act and the Reserve Bank of India guidelines, every before it opens any place of office requires a from the Reserve Bank of India. Now, it does not necessarily define the nature of activities. So it is a physical license. So once you have a physical license, you can do certain activities and you can centralize certain activities. It does not stop you from centralizing any activity. So when you go to the branch will collect your form, scan it to the centralized processing center, and somewhere in the regional office or central office of the bank, you can do the processing and take the decision. That's perfectly okay with regulation.
Absolutely. And just to add to that, Ketanji, when you are looking at a digital model, the whole point, because even if I am going to location and putting up a branch, customer might be located about 25 kilometers, 30 kilometers from the branch. So it is really inconvenient for the customer to even come to that branch and do the needful, right? And I think there are regulations around opening the liability side of the branches. On the asset side, as long as the lender is kind of convinced about the fact that I'll be able to touch base with the customer if there is a handholding required tomorrow, and I have the capability to reach out to customer, and customer has good connectivity there. I mean, from an access point of view, I think this is what typically we look at, and then we go ahead and onboard those locations. But yeah, I think going forward, some of the regulatory clarity will really help to kind of evolve this.
Let me just go a bit outside of lending, and I can tell you that even the KYC of your account opening form, your check processing, demand of your fixed deposit issuance, renewal, all these activities are now centralized in the central processing center. I can tell you that I used to work with ICICI Bank more than 20 years ago, and they opened a global trade finance unit in Churchgate. That was one of the first GTSU established by them, and it was a centralized office of all trade finance back office. So it is just beyond lending activity, several activities. Now the branch of a bank is just a customer contact center and data collection or customer facing unit. That's it.
Thank you. And Dnyanesh ji did touch upon Grameen Bank. So thought came like a lot of RRBs we have Grameen banks and a lot of small cooperative banks in rural areas. So maybe a technological question, maybe Vikas ji can answer or something like that. See, today a product like Finacle is very costly. When we do a lot of cooperative also as an auditor, like I talk about myself. So, but we see that those products which these banks are using, these small time banks are using, are not technologically as equipped as a product like Finacle is. And now we have fintech companies coming in. So I am, just a question to my mind that what will be the future of these banks? Like there also we see the young generation is using now apps and all those things. So what will happen to this, RRBs or Grameen banks, and how will they survive? Or is there an opportunity again, for this fintech to tap these type of RRBs or Grameen bank, to scale up?
That's interesting. So we do work with some banks, and we provide what is called a build and operate model, where we basically manage the complete the lending flow. Since we predominantly obviously not do banking, but predominantly lending only. So we manage the whole lending flow with virtually no tech investment or people investment on the other side. So like we are doing some work with Bank of Maharashtra in this space. So what we are seeing is that it's now no more possible to buy a FinOne or something like that and it's costly obviously for a small bank and then customize it, because tech teams are not available. The bank doesn't have the skill set or the inclination to build a technology team to be able to implement all this. So most of these models will fail. The one which will work, we believe, is the build and operate model, where basically a Grameen bank or will tell these partners, hey, you manage my complete flow, you build it, you operate it, you host it, you do every damn thing. I will just lend money, right? So those sorts of models are now coming in front. So when we talk to a lot of partners, like one of the PSUs reached out to us and said, hey, we want to build the journey for sourcing customers. So they are more into agri loans. So they reached out that, hey, can you help us set up tractor loans, vehicle loans, farmhouse loans, all that stuff. Now these are not there in part of any of these packages which are available. So what these guys are doing is they're splitting their whole flow earlier from a complete integrated flow to, hey, the sourcing flow is different, the collection flow is different, and just sticking to a FinOne or something for the LMS part or just the accounting part. The formal part, let's call it the formal part. And the rest of the branches or the peripheries, sourcing, LOS, collection, they're taking out the bits from the core and working with partners on that. So once the Grameen banks and all also figure out that this is the future, where they most probably just want to own the core data, so they will most probably go for a reduced version of FinOne or somebody who will assure them that their core data and the actual banking data is secure, and with them all the other peripheries will come to partners like us or to people who do build and operate models. So that's the way I'm looking at tech moving in the future.
So Vikas ji, one question relating to this, because I have been interacting with these type of small banks, is they say that हमारा data कितना secured है, yeah, they are afraid about the data. So is there any certification like CARE, CRISIL or something like that, something in technological space which says that, okay, look, Vikas company is safe, or your data will be safe? Because हर बार एक question आता है कि our customers data is very, very confidential and we can't share with the outsider, and there are RBI restrictions also upon that.
Okay, yeah. So I can answer both these parts. These are standard questions which come to us also. So if you want to verify a partner, there are enough, like for example, in payment gateway space and credit card space, you have to do what is called PCI DSS compliance. There's n number of certifications you can get. But more important than that, what people are getting us to do, like so in the case of Bank of Maharashtra, our product is hosted on their server. So the data never flows out of the system at all. Right? So rather than you imagining a scenario where the data is coming to me, I am processing it, and it is going back to there, what's happening is my software or my SaaS or my app is on their server, and it is talking locally, and the data never leaves their premises or their server. So the security issues get to a large extent automatically resolved, because the data is not getting out, and they own the server and they own the whole system itself, and they do a security testing of whether that product is okay within their system, and that product cannot talk to any external entity at all. So once you do put this, you're more or less secure. So this is the way all of the PSUs and all have figured it out, and that's how they're. So you see an SBI, you see a Bank of Maharashtra, they're all engaging with fintech companies, and they're all using this same model that, hey, I will not send you data. You put your stuff onto my server, which works fine. So that's how it is going to be.
Yes, thanks.
Ketanji, very quick comment from my side. So the level of technology in any bank will largely depend upon the business strategy driven by the top management and the mandatory regulatory requirements given by the regulator. So once these two things are achieved by the bank, I think they would win. So they definitely need to understand what is the requirement to drive their business and what is the requirement to comply with the
People are
Correct.
overreacting, honestly. Many of the small banks are overreacting that they will lose their data, right? Its chances are higher that their employee will steal their data than a partner will steal their data, because employees are most probably the most unregulated entity in the whole system, and it's quite reasonable. A lot of people have access to data within banks, within all these ecosystems. Usually the leakage does not happen by partners, right? Usually the leakage happens by employees inside. So I think partners and all are equally sensitive to data, and they also have to be in this industry. If they are accused of data leakage, their licenses can be revoked. So I think the sensitivity is there. It's just that small banks are not able to trust, right? I think the bigger issue is not security but trust.
It's out of their traditional comfort zone.
Yeah, I think that is the bigger challenge, but you have to establish trust at some point, right?
True.
And in terms of technology, it is something that you can expand it as much as you want, and you can contract it as low as you can. So even talking about Finacle software, you can extrapolate it, as much as you want, or you can select only a few features of the system and you can downsize it. So it really depends on the needs of the business.
Yes, thanks a ton. I think we had eminent treasure of panelist today, and special thanks to Rahul Javeri for I've been chasing Rahul and bothering Rahul last few days, and special thanks to Dnyanesh ji for moderating the entire session. Obviously, I'll the formal vote of thanks I'll request CA Piyush Chandak, RCM elect. Piyush, you can take over and propose a very well-deserved vote of thanks for this session as well as for the entire yesterday and today's banking conclave. Over to you, Piyush.
Thank you. Am I audible, Ketan bhai?
Yes, Piyush bhai, yes.
Thank you very much. I'm here to propose a formal vote of thanks. We just had a session on NexGen banking with the great panelists like Mr. Chandan from Flexiloans, Mr. Vikas from CTO, Mr. Lokesh Chaturvedi, and which was very well moderated by Dnyanesh Pandit from Protiviti, and also coordinated by Rahul Javeri. And wherein we heard the discussion from Vikas ji about use of data from Zomato, Swiggy, and stability of the person asking for loans, genuineness of data using, verifying genuineness of data using artificial intelligence, and coordinating basic financial data, generic data, and surrogated data. Like even Chandan ji thrown light on underwriting and centralization of procedures of this credit appraisal. And Lokesh thrown light on transformations in products and regulations and reportings. We also had a discussion on frauds, scams, and willingness to repay whatever loans are taken by the loanees. And also we discussed on economies of scales and also the anchor relationships and various more concepts, various evolutions and challenges in the NexGen banking. I thank all of you to share your views and experience about this. And I think we must, all of the attendees have learned a lot from the panelists by sharing of their knowledge and experience. I thank all of you. I'm now propose a formal vote of thanks. And thank you very much from WIRC for sharing your knowledge and experience. And also, we had in last 2 days various dignitaries and various panelists who had shared their knowledges, and this word of thanks must go on to all the participants as well who had been present throughout the Saturday evening and Sunday morning, and in the light of Valentine's Day. So I think I should thank all of you. Thank you very much. Thanks a lot. Thank you, Ketan bhai, for the opportunity. Thank you.
Thank you, Piyush bhai.
Thank you, everybody.
Yeah, thank you, everybody. And we formally, conclude this both the days banking conclave, and looking forward to all the dignitaries for future programs of WIRC. We'll stay in touch. Rahul, Dnyanesh ji, thanks a ton for, this entire session and making it successful. Thank you so much. Thank you.
Thank
Thank
you.
you. Thank you.
Thanks, everyone.
Bye.